This flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
First up, everyone, U.S. stock futures fluctuating this morning after Nvidia plunged by 17% in Monday's trading session. Worst day since March of 2020 for the name. The stock currently pushing higher after shedding a record $589 billion from its market cap. The massive sell-off prompting bubble calls from some Wall Street investors, with billionaire Ray Dalio likening the behavior to the run-up before the dot-com crash in 2000.
Plus, we have the dollar strengthening against every major currency here this morning after President Trump said that he wants to enact across-the-board tariffs that are, quote, much bigger than 2.5%. Speaking to reporters, President Trump also pledging tariffs on specific sectors, including semiconductors, pharmaceuticals, steel, copper, and aluminum. The president also suggesting that he could impose tariffs on cars and trucks from Canada and Mexico. Now, he's already threatened 25% across-the-board tariffs as soon as this weekend.
And earnings season continues with results out from some big names today. General Motors seeing a better than expected profit outlook thanks to a rebound in China and the wind down of its robo-taxi business. But the automaker warned that plenty remains uncertain in the early days of the Trump administration.
I do think he has a very good understanding of the implications of tariffs or changing IRA, the stringency from a standards perspective. I think he has a very good understanding of all of it as it impacts the domestic and U.S. auto companies and the overall manufacturing sector.
Meanwhile, Boeing reported a $4 billion operating loss in the fourth quarter and a loss of $20.38 per share for the year. Boeing CEO Kelly Ortberg planning to realign the company around key business lines and sell off non-core assets. Ortberg aiming to fix cultural dysfunction and improve production, but facing some challenges including quality control and financial issues.
Stock futures are clawing back some losses this morning. We are mixed among the U.S. major averages. This coming after Monday. China's AI model torpedoed tech giants, namely Nvidia, and the chipmaker shed nearly $600 billion from its market cap in Monday's session, largest loss in market history for the company. And retail investors, they took advantage of the dip, buying more than 550 million in shares. That's the largest amount on record going back to 2014, according to Vanda Research here. But the larger question, too, is off of yesterday's activity, how much of that and the bounce that we're seeing a little bit here today, how much of that will hold? Are we in the dead cat bounce territory, or is this something that is more pronounced or prolonged? Now, everybody would be right to also look at a longer term chart. Yesterday's decline included, but then also if you're looking at some of the moving averages, Nvidia broke through a 200-day moving average. The larger question that I have is, are we going to see, especially extended hours pre-market, as we've gotten back above that 200-day moving average, is this a sustained move back above that, or is this the lead to what Ray Dalio is calling out in some of the early setup that is similar to what took place in the dot-com bubble?
Yeah, I think if history is a guide, it is a bit concerning, right? When you take a look at the past to some of the larger sell-offs that we had, specifically with Nvidia, and going back to the last 8 times, it actually fell more than 17%. The next day, it only closed higher 3 of those times, so far less than half. So we could see potentially a bit of a reversal here as we do wait for the trading day to get underway, and then, of course, throughout the day. The one silver lining, though, I think for investors, and very much has been the focus, it's been in a lot of notes here this morning, is just the concentration of yesterday's sell-off. Yes, we did see deep sea of red here when you take a look at many of those larger cap names, when you take a look specifically at the Nasdaq, with the Nasdaq closing off just about 3%. Obviously a bit worrisome here when you take a look at a name like Nvidia, given the size, the magnitude, how important it has been to the market's overall momentum here over the last several months, falling and falling so dramatically. But when you take a look, I say the S&P equal weight index, that was essentially unchanged yesterday. When you take a look at some of that price action, even beyond that, certainly a bit encouraging here. Majority of the S&P stocks actually ended the day higher. You had the advanced decline index, and that measures stocks rising minus those that are falling. That showed a positive reading of 199, even as that benchmark fell just about 1.5%. So again, that puts some of this selling into context. And yes, while there is reason to be concerned, and you see why some of the larger, well-known investors like a Ray Dalio, or maybe drawing larger comparisons to what has happened in the past. I think it is a bit reassuring here for investors this morning that you can easily, I think, make the argument that the bull market is still very much intact.
Yeah, the major question that is unanswered at this point is there a crack in the secular trend here? And from the conversation we had yesterday with Stacey Raskin, and then additionally we had Dan Newman on, and in their conversation with us, they said the secular trend remains intact at this juncture. However, UBS out with some research here this morning too, and they also tend to think the magnitude of the moves today will ultimately prove yesterday's reaction to be overdone, though the overhang may persist until those key questions specifically about the secular trend are answered. We're not going to hear from NVIDIA until, at least on the earnings front, until February 26th. Meta's perhaps one of the first instances that we'll finally get of continued not just AI spending, but also the monetization of that early on, at least with that as the major theme that's driven the markets for the past 2 years. And oh yeah, as a reminder, our conversation with Mohamed El-Arian last week, he reminded that after 2 consecutive years of 20% growth, it's highly unlikely that we would see a third. However, it is still within the realm of possibility that you would still see gains in totality and aggregate here.
Yeah, certainly. And when you take a look at the market's activity this morning compared to what we saw yesterday, it is a bit eerily quiet, at least right now when you take a look at some of the volume and some of the action that we are seeing. We also have earnings out this morning. We also have an update there from President Trump in regards to tariffs. We're still talking about, obviously, the focus here this morning very much being that stock that's on your screen right now, NVIDIA. We are looking at gains here just about 2.5% ahead of the open. Well, the DeepSeek-driven tech sell-off is cooling in pre-market trading after the Chinese firm's AI model did rattle investors and also called into question big tech's massive AI spending plans. But will the sell-off continue, or some of those fears overblown? We want to bring in Dom Rizzo. He is T. Rowe Price's Global Technology Fund Portfolio Manager. It's great to have you here, Dom. Talk to me just about this bit of a rebound that we're seeing this morning. How convinced are you that we're going to see that carry on with that momentum?
Well, first off, thanks for having me, guys. Really appreciate being here. Well, if you think about what's happened, DeepSeek really gave this incredible innovation to the world in terms of model efficiency by open sourcing their V3 and their R1 models. And quite naturally, the first market reaction is, oh my gosh, GPU utilization's getting better, memory utilization's getting more efficient. That must mean that AI spending goes down. And I actually think the take is a bit more nuanced than that. I think in the short term, maybe we could see some short-term consolidation. But over the medium term, there's actually a lot of things within the DeepSeek paper that actually implies that compute intensity and GPU intensity could go up, whether it's things like reinforcement learning or models that train other models, or that synthetic data works. So I think it still remains to be seen.
With that, what are, and of course there's several remains to be seen kind of question marks out there, but what does this tell us more broadly about where the competitive environment, it still hasn't fully been factored in to how some of the names that are out early in front and trying to entrench themselves within this AI theme are being traded?
Well, absolutely. Look, how much spend is going to be ultimately done by the hyperscalers is really a business model question. I'm not sure it's actually an AI question. And it's a business model question in the sense that, do you have proprietary applications that can justify the incredible spend of these leading edge models? And I think that we're probably starting to see some evidence that a few players are going to keep going down the spend race, and maybe some are going to take their foot off the gas pedal a little bit. So if we looked in the past few days, we saw Mark Zuckerberg tweet that the post on all of his properties that he's going to spend $60 to $65 billion in GPU capex next year, and this is that 2025 will be the year of AI. Sam Altman said that he expects them to continue to spending and keep moving forward. And so you can see those AI labs take the efficiencies from the DeepSeek model, apply them to their models, and then throw a ton more compute at the problem and throw a ton more memory at the problem and a ton more dollars at the problem, frankly. And maybe you're going to see many, many multiples of performance improvement. Others, though, like Microsoft, I think, 80 billion, we're starting to get to the point where if you look at their cash flow from operations, minus that 80 billion and the $23 billion of dividends, that's getting a little close for comfort. So I kind of see why they're actually maybe pulling the foot off the gas a little bit there. And so I think it's really company by company and business model by business model if you could justify this spend.
It certainly, and Don, when you take a look at some of the reaction that we got from big tech executives yesterday, they seem to brush off some of these concerns, very encouraged just about maybe what this means for broader AI adoption. I'm curious, just from an investment standpoint, does this at all change your strategy of identifying some of those future winners here within the space?
Well, we always make our investment decisions based on our framework. We're looking for linchpin technologies, innovating in secular growth markets with improving fundamentals and reasonable valuations. And I think the one area that I think this is unequivocally good for is enterprise software. If we look at what DeepSeek means, it means that cheap, high-quality AI is going to be proliferated everywhere. And that's going to be great for enterprise software applications like SAP, ServiceNow, Workday, HubSpot, because it's going to be able to put that intelligence in everything we do. I also think it's great for a company like Apple, where, frankly, Apple Intelligence has fallen quite behind all of the state-of-the-art models. They're going to be able to catch up relatively quickly by relying on that open source. And it's probably great for the hyperscalers because those are guys who are really the platform of platforms, and they have models from all different vendors. So names like Microsoft and Amazon really benefit. Over the medium term, though, I actually think that digital semiconductor trade is still on, and that we're going to see compute intensity continue to rise as a result of all the AI spend. And I think that we have to wait and see some of these models that are going to come out, whether it's Grok 3 and Llama 4, and see how performant they are relative to, say, DeepSeek's R1.
Tom, where does that leave NVIDIA?
I think that NVIDIA is kind of the big fight on the market right now between the bulls and the bears, and I still come out on the bull side of the equation there. I think NVIDIA remains incredibly well positioned for training, and I still think that we're going to see those training of those large language models, whether it's from Meta, whether it's from OpenAI, at very, very high levels of capital intensity. The question, I think, remains on inference. Do we end up doing inference some sort of way going forward that's not NVIDIA? I think NVIDIA is probably still in the lead for inference, but that remains to be seen. If we look at the valuation, it's relatively reasonable, actually, particularly after the pullback that we've seen, and I think that NVIDIA still looks relatively attractive over the medium term.
If we start talking more about inference than we do the actual chips that are being used to run that inferencing, then are we shifting into kind of the LLMs or even the applications cycle and ramp cycle in the AI thesis here? And what does that hold for this earnings season in particular? Does NVIDIA lose its bellwether status for this earnings season or going forward if the conversation starts to shift towards more of the applications or the language learning models that some of the software companies you mentioned are really prioritizing?
Well, I think we're going to know a lot more this week, particularly after Meta reports on Wednesday. So let's wait and see. But I do think that we're probably in this stage where we're going to start to see AI proliferation. And what that means is for us trying to find companies that are going to be able to utilize AI to really have an improving fundamental inflection in their business models. So see if they can have revenue that's accelerating or operating margins that are expanding because implementing AI into the business case. All that being said, I still think NVIDIA remains the AI bellwether stock. And so then you actually have to take a step back and ask yourself, are we kind of at that crescendo point in the AI cycle? You referenced Ray Dalio's bubble comment. I think AI has the potential to be the biggest productivity enhancer for the global economy since electricity. Historically, productivity enhancing technologies are accompanied with speculative bubbles. The question is really, are we in 1997, 1998, or 1999 right now? And that remains to be seen, but we're going to try to keep navigating that responsibly.
Yeah, Ray Dalio certainly inserting a thought of diminuendo into the markets here this morning. Dom, appreciate it, and the music references as well. Thanks.
Thanks for the time, guys.
You too. Have a good one. TikTok may have a U.S. buyer. President Trump told reporters on Monday Microsoft was in talks to acquire the social media company. Trump's latest comments come after he disclosed over the weekend that he was in talks with multiple people over buying the social media app. Sources told Reuters that the White House was working with Oracle and a number of U.S. investors to take over TikTok's U.S. operations. And under the deal being negotiated, the app's parent company, Chinese-owned ByteDance, would reportedly retain a stake, and U.S. investors in ByteDance were involved in talks. Microsoft has not yet commented on Trump's claims.
If true, this would be the second time that Microsoft has eyed TikTok. Back in August of 2020, after then President Trump demanded TikTok's Chinese parent company spin off the U.S. app, Microsoft was in talks for a deal to buy the app. Those discussions ultimately falling through. At the time, CEO Satya Nadella calling the near acquisition, quote, the strangest thing I've ever worked on. Well, coming up morning on Morning Brief, we've got full earnings coverage ahead. We'll bring you our sit-down interview with GM CEO Mary Barra. Plus, Boeing out with its results. We'll break down the biggest takeaway from their numbers. And we count you down to the opening bell on Wall Street following NVIDIA's record wipeout. We've got all that and more coming up on Morning Brief.
Now time for one of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's go where the planes go, to the skies. Boeing reporting an annual loss of $11.83 billion, its largest loss since 2020. The aircraft maker also missing estimates for the fourth quarter after giving advance warning to investors last week about the expected impact of the factory workers' strike, which lasted more than 7 weeks in the fall. Still, CEO Kelly Ortberg says the company, quote, made progress on key areas to stabilize operations, end quote. Shares right now up pre-market by about 4%. They did say say, of course, within this most recent quarter that they finalized that International Association of Machinists and Aerospace Workers, that IAM agreement, resumed production across the 737, 767, 777, and 777X programs. That was so key as well here. And then ultimately, it still does come back to how they're going to turn the plane around here with some of the financial results. It still was a GAAP loss per share of $5.46 in the most recent quarter.
Yeah, I think the reason why we're not seeing a bigger reaction here in the pre-market trading action here for Boeing is because this is very much in line with what we heard last week with their pre-announcement here. What's jumping out to me here this morning, at least, is some of the commentary. Actually, we are seeing a bit of a tick higher here. I think a lot of this has to do with some of the CEO commentary that we are getting. Just doing an interview with CNBC saying that he doesn't see any major structural redesign here of the company. He does see a few transactions this year, some more advanced. Of course, that has been a question here. We've talked to so many analysts over the last several months here about what the future looks like for Boeing, whether or not M&A, whether or not a readjustment there of their business, what exactly that looks like as they do try to focus on some of those core assets. So him saying that a few transactions could be in the cards this year. He's also asked about the Trump administration. He was saying that he expects that to be, quote, very supportive there for the company going forward. So very optimistic. And I think that's why we're now looking at shares actually up just about 4%, a bit of a dramatic reversal than what we saw earlier today when we were just up just about 0.2%. So again, the street a little bit encouraged about some of that commentary coming out from Ortberg, not only on the call, but also from this interview and the direction that Boeing seems to be going here at this juncture.
Yeah, one of the major concerns, especially as you bring up the Trump administration, if tariffs do go into place, it's going to be a larger question of where they're sourcing the aluminum from as well. Most modern aircrafts, 80% of that aircraft has a large component of aluminum in it. And so that would be a considerable hit, or at least a consideration for Kelly Ortberg and the management and production staff to really figure out, okay, what does that sourcing look like? Do you pull forward some of those orders as well in anticipation that we could see those tariffs go through? So that is something that I imagine that they're weighing here, especially within this plan. But I think within this pop that we're seeing here ahead of the open, there's perhaps a sentiment among some investors out there that they can't possibly do worse than 2024. It would be quite difficult. And so maybe a worst is behind them type of thought is prevailing, at least pre-market right now.
Yeah, and I think that very much explains some of the bullish views that we have been getting out from the street here ahead of these results, and really over the last couple of quarters, just the expected improvement there, just given how far and how fast Boeing has fallen. All right, utilities providers, including Constellation Energy and Vistra, recovering some ground in pre-market trading after shedding double digits off concerns about Chinese AI DeepSeek. Now, Jefferies analysts in a note out this morning saying, quote, data center deployment is very likely intact in the medium term as the race remains on. The question for us remaining, just how swiftly will further competitors release new, more powerful AI models? Let's talk about that and much more. We want to bring on Paul Zimbardo. He is Jefferies U.S. Power Utilities and Clean Energy Research Managing Director. It's great to have you here. So talk to us just about the magnitude of the drop that we saw in so many of these utilities names yesterday. Is the worst behind it, or are we likely to see more pressure just given the cost and energy efficiency that we have heard about DeepSeek?
Yeah, no, thank you for having me back. So hopefully the worst is behind us, but I don't think we're all clear yet. And just putting things in perspective, some of these stocks have been up 20 to 50% just to start the year to date in January. And if there was a little bit of exuberance, and as you remember when we were last chatting, that kind of the AI thesis was going to lead to significantly higher power contracts. And this is kind of the first wrinkle in that trade that we've really seen over the past year. So hopefully we can kind of resume some of that upward trend, but this really does kind of cast some uncertainty into that thesis, which has become an investor's base case.
And we're kind of painting a broad stroke over utilities, but are there some players within the space that are better positioned than others, even with the efficiency as the prioritization for how data centers will be operated, and how, if we see, of course, a sweeping overhaul to the way that inferencing technology runs through those data centers and the compute power that's necessary, that all that energy and the utility power that goes into it is still sustaining the overall kind of output that we're looking for here, and which utilities are perhaps the best insulated?
Yes, no, absolutely. So to break apart the traditional utilities from the power companies, one of the utilities that is more insulated is PPL. So there you are building a lot of new natural gas in Kentucky, really just to replace kind of retiring and older resources, as well as very modest demand growth. So to the extent there's data centers that proliferate in Kentucky, that would be incremental to the outlook. So we think that is one of the safer ways to play it. Within the power world, we like Talon. So this is a large nuclear plant in Pennsylvania called Susquehanna. They already have an existing data center deal with Amazon. Amazon is actually on site building that facility. So there's really just one core asset for that company. And given that existing relationship, we think it's likely that kind of that relationship gets expanded over time.
Are you reevaluating the energy needs right now of U.S. AI? And I guess just given what we do know, what do you think that looks like?
You know, it is the core question. So to set the stage a little bit, artificial intelligence and data centers specifically are about 75% of the demand growth projections. We've had flat demand growth for 20 years in this country. So kind of all of our eggs are in that one basket to a degree. Electric vehicles, port electrification, other ones are pretty small. So I think the question is the hard one to answer of what really happens later into the 2020s and 2030s. Do we have this large boom? Because as we've written, we don't think that the data center companies really pull back on deployments 25, 26, 27, even 2028. But you do need to start to question kind of, does that trend accelerate in the future? Does it kind of stabilize and maybe even see some moderation of demand growth out into the later in the decade?
What type of kind of capital expenditure profile are you expecting from utilities companies in order to meet the demand that AI is bringing towards their industry?
Yes, yeah, no, the average utility probably grew its kind of infrastructure base maybe 6-7% in the past. We have many companies now that are talking about double-digit growth, some as high as 15% infrastructure growth through the early 2030s. So really unprecedented levels. And to compare that with some of the slower growth regions of the United States where you don't have data centers, that's more like a 3, 4, 5%. So like significant increases. Just how long does that trend last?
Paul, when you take a look at where Constellation is, you take a look at where Vistra is this morning, should investors be a buyer at these levels, or do you think there's more room to fall?
You know, we would definitely be a buyer of Vistra. So what we have done, we look at kind of draconian scenarios, assuming there was no data centers. Constellation would have further downside. It would have pretty significant further downside versus a Talon, we think is cheap ex data centers. Vistra, cheap today. So like those are kind of the ones that we'd be looking at the most. A Talon followed by a Vistra. Even after the drop yesterday, Constellation kind of pre-open was just trading around our price target, just to give a magnitude of how much it's outperformed to start the year.
Paul, thanks so much for taking the time here with us today. Really appreciate it.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Here comes the opening bell on Wall Street as investors look to forget maybe the sell-off that we saw yesterday, led by some of those larger tech names, notably NVIDIA, wiping off $589 billion from its market cap, a record there. Clearly spooking and triggering some concerns, more broadly speaking, sending some ripple effects across the broader market. You had the Nasdaq closing down yesterday, off just about 3%. We're looking for a bit of a rebound here this morning. When you take a look at the S&P's trading action here right at the open, you're looking at gains of just about 0.2%. When you take a look at the Dow, it's just above the flat line. Not seeing a whole lot of action here yet as we do calibrate here at the open. But take a look at the Nasdaq. Again, you had the Nasdaq closing off yesterday just about 3% here. You're looking at a bit of a rebound here today, if we can call it that, up just about 0.4%. Inside some of those smaller cap names, the Russell 2000, though, still in the red here this morning, off just about 1%. When you take a look at the bond market, let's check in on yields. You're seeing a bit of a move to the upside, still that 457 level, so below 4.6. But let's take a look inside that sector action, especially coming off the magnitude of the sell-off that we saw yesterday within the tech sector. You're looking at tech leading the trading action here this morning, up just about 0.8%. The big question, though, for investors, whether or not this rebound and some of the buying action that we're seeing here at the open, whether or not that's going to hold. And of course, when you put in the context of the broader market, when you talk about the concentration of yesterday's sell-off, whether or not that is actually maybe a silver lining here for investors, more broadly speaking. On the flip side, you got consumer discretionary, consumer staples there in the red, leading some of those declines. Inside the Nasdaq here, as you take a look at some of those individual plays, you got NVIDIA opening up nearly 2%, move to the upside here. So off the highs that we saw earlier this morning, but again, a reversal there from that 17% drop that we saw yesterday. You've got Apple up just about 1.4%, coming off actually a strong day yesterday, bucked that downward trend. Meta up just about 1.5%. Google also reversing some of those losses that we saw yesterday. On the flip side, you got Amazon and Microsoft just below the flat line. You've also got Tesla off another 1% today. Again, a huge week here for big tech, not only on the heels of the developments that we got on DeepSeek and some of the fears that introduced into the market, but really the real takeaway was what this does in terms of calling into question some of big tech's spending plans on AI. And we'll get a little bit more details on that over the next several days here as we're hearing from many of those big tech companies' quarterly results here for the fourth quarter. Let's kick it over to Yahoo Finance's Jared Blakely for a closer look at some of the movement that we're seeing here this morning. Jared.
Thank you, Shauna. Let's go to the major indices. We had quite the split yesterday. And by the way, if the S&P 500 didn't have NVIDIA and didn't have Broadcom in it, it would have been positive. So yesterday, well, right now we're seeing the Dow exactly flat, just down a little bit. Yesterday it was positive. Let's put the 2-day up there. S&P 500 was down. Nasdaq was off even more. This is the 2-day look again. And I just want to add that this stat comes via Jason Geffert. 70% over 300 issues in the S&P 500 closed in the green yesterday, despite that 1.5% loss that has never happened going back to collection of data in 1957. So that's just an historical anomaly. And we had some close calls. Those were in 99 and 2000. And if you're paying attention, that kind of matches up with the tech bubble. So maybe a little of a concentration warning right there. Here we have the 10-year T-note yield that is bouncing back 4 basis points from yesterday's 10 or 11 basis point drop. US dollar index is also bouncing back. But I would just consider this a little technical bounce after yesterday's action and drubbing in the tech market. And let's go to the sector action, because this is really interesting. Tech was the worst performer yesterday, bouncing back a little bit today. Energy also in the green. The consumer discretionary, the best performing sector since the election, that is taking it a little bit on the chin, down about 0.6%. Also want to mention that yesterday, staples beat tech by the biggest percentage since 2002. So that's another historical stat that was kind of standing out from yesterday. Want to get back to our Nasdaq 100, where we can see Apple. I said earlier that some of yesterday's winners and losers had traded place. Well, yesterday's the big winner was Apple, closing up over $100 billion in market cap. It is up another 1.5% today. If we look at the 3-month chart, let's get the 3-month, there we go. Not shown here is the 200-day moving average, just bounced off of that perfectly last week. So Apple just showing that sector rotation is alive and well. NVIDIA's loss, not quite Apple's gain just yet, but we'll have to see how that plays out. Want to leave you with Bitcoin. Bitcoin is holding 100,000. I believe it jumped into the 97,000s yesterday, so it's bouncing back. But again, that big psychological number still in play and holding 102,500 right now. Brad?
Jared, Thanks so much. Really appreciate it. It's time now for today's strategy session. Hedge billionaire Ray Dalio warning that in the recent market action, it's very similar to behavior last seen before the dot-com bubble burst. In an interview with the FT, the Bridgewater founder said that some people are confusing major new technologies with investments being successful. Joining us now, we've got Drew Pettit, Citi U.S. equities strategist here. Drew, does the emergence of DeepSeek change your overall investment thesis?
Right now, no, we're trying to be patient. Look, yesterday happened really fast. The sell-off was really aggressive. AI remains one of our top themes. We do think it is a game changer. But the one thing that's really not changing our tune, and I would really stress this, is when we invest in new technologies, we want to have exposure across the value chain. What we saw yesterday wasn't a broad AI sell-off. It was an AI enablers. So think the picks and shovels that sold off. The creators actually, that application layer hung in pretty well. And some of the companies that we view as potential early users of the technology, they were actually up yesterday. So when we think about new technology, let's diversify across that value chain, and that's how we manage volatility like we had yesterday.
Drew, does it make you more worried, less worried, maybe thinking about it the same way when we talk about the concentration in the market and just how significant and how important that few handful of names are here to the broader market picture?
Look, it makes my job a little bit more difficult. We're not sitting here talking about macros and GDP every time I'm on, right? We have to talk about the Mag 7. But concentration in and of itself does not scare us. I know people are going to come on and give you statistics about it over and over again, but this is like a U.S. sphere. The rest of the world is kind of used to concentration in their indices. Where concentration becomes a problem is when it's in a growth stock and we start to get worried about the long-term fundamental trajectories. And that's really what shocked the markets yesterday when it comes to something like NVIDIA.
But even the prices and the share price appreciation that we've seen is front-running the expectations and the realization of some of the monetization strategies, some of the revenue and profit correlation coming along with it. How far out do you think the markets are looking and investors are looking even within this concentration of that long Mag 7, long tech trade?
Yeah, it's funny, like thinking fundamentally about this, we kind of think about like that 3-year number. There's a lot of estimates there. We try to figure out what's the market pricing for the next 3 years. And where we were leading into this is the markets were pricing in a lot when it came to earnings growth. So anything to dent that story ends up being a negative. The bigger the story, the bigger the dent. It kind of explains a little bit of yesterday's action. But beyond that, where I think we get a little bit concerned is what multiple you put on those really big names. Right now, we're willing to pay a premium because we thought we had a lot of earnings visibility. Yesterday shook that a little bit. So for us, it's really focusing on not the quarter, maybe not even the year, but the next year or two, because I think if you're going to re-engage these names, you have to see earnings growth follow through.
Drew, let's talk about the other, one of the other big elephants in the room or big question marks here for the market, and that is tariffs. When you hear the developments overnight from President Trump and maybe his plans here for universal tariffs or what he wants to see happen, obviously we've seen so much rhetoric. I guess my question to you is how much is the market appropriately pricing in the tariff risk from your perspective?
I don't think so. And if you actually look really closely at the sensitivity to the US dollar, honestly, to us, that is the macro you want to focus on when it comes to tariffs, not interest rates, not commodity prices, the dollar. I do not think the dollar has fully reflected tariff threats, which means I don't think the equity markets have fully, priced it in as well. So tariff risks linger out there. And honestly, I think that kind of explains why you had that little bit of a dollar move overnight. And on top of just the dollar move, keep an eye on dollar volatility. That actually fell over the past week, and now we got tariffs hitting the headlines again. So higher dollar volatility, both are equity negative.
All right, Drew Pettit, always great to get your insight. Thanks so much for taking the time to join us here this morning.
Okay, good to see you.
It's time now for our chart or charts of the day. Our very own Josh Schaefer is with us. He's looking at two charts that tell us a story about tech's dominance in the market from the 4th edition of Yahoo Finance's chart book. Check it out. It's on Yahoo Finance's homepage here today. Josh has put a lot of hard work into this. What is it, 44 charts?
44 charts, yes.
Okay, 44
we spent the last month, Shauna, asking economists and strategists what the most important chart is for investors right now. So there's a lot of key themes you can check out.
There's a lot of key themes, and we're going to highlight 2 here this morning, but you definitely want to check it out because we're not even scratching the surface here. But the 2 charts that you have, we chose here today because it also, I think, illustrates and maybe puts an emphasis on some of the trading action that we've seen over the last 24 hours. Its significance.
Definitely. So the first chart I want to highlight here is from Vinu Krishna over at Barclays. And what this chart shows us is EPS revisions over the last 12 months. So that big white line you can see on your screen, that's clearly the outlier. Guess what? That's big tech, right? So that's Mag 7 minus Tesla. Tesla's not included in that. The line below that would be the S&P 500. The line below that is the rest of world. But really, guys, what I think the takeaway here is, as far as the last day of market action, look at that white line. It's just been consistently moving up. As Keith Lerner also told us in the chart book, a key pillar of this bull market has been earnings estimate revisions continuing to rise with stocks. This has been a fundamental stock market rally. Well, what happened yesterday? We got real questions on whether or not that white line is going to keep moving up, right? Whether a company like NVIDIA is going to just keep its dominant market share and keep growing earnings at this impressive pace. And I think we got a little bit of a taste of how the market reacts if big tech earnings are not going to keep outperforming. Perhaps at an index level, it could be challenging for investors.
Wow. Okay. All right. And you had
chart two, Brad. All right,
yes.
chart 2.
Let's go to that one.
So the sort of the other flip side of that is there's still opportunity in this market, right? So you're looking at a chart from Richard Bernstein here, and what he's highlighting is we had a near record level of stocks outperform the S&P 500 over the last 2 years. So it was 30% of the S&P outperformed in 2023, 29% in 2024. We haven't seen the market with that little of outperformance since the late 1990s. Bernstein's point here being that's not normal. Look at the average dotted line there. Bars are normally right around that average line, if not over. He's sort of arguing for a broadening out rally sort of trade. And again, guys, going back to yesterday's market action, 70% of stocks in the S&P 500 closed in the green.
Yeah.
So there was some level of rotation. I just think the takeaway is, once more, if you're an index investor, rotation's going to be a little bit harder than the bull market we had over the last 2 years.
It's going to be harder. It's going to be rocky. It's going to be volatile. There's going to be some tougher days. I think it's easier to say, at least the least. But how should investors be, I guess, a bit more confident or reassured then that we did see something like the S&P equal weight there remain relatively flat yesterday? We didn't see too much change.
I mean, it depends on what you own, right?
Yeah.
If you own the broad S&P 500 index, then sure, there's some signs of strength within the fact of how many stocks closed higher. But also, and NVIDIA is not going to fall 17% every day, right?
Hopefully not.
Hopefully I'm not making a market call here, but that would be surprising to see it continue to fall, right? And that's really what dragged down the index. When you look at, it was over 2/3 of what dragged down the S&P 500 was NVIDIA alone. So I do think you could look at yesterday and say, okay, little bit of concerted risk here, and maybe, or concentrated risk, I should say, and maybe the broader story hasn't changed as much. As Drew was just saying, with some of the AI names that could actually probably benefit from the launch of DeepSeek.
And the tone has very much been optimistic. I think across the board from many of the strategists, even in the wake of the selling that we saw yesterday too.
Yeah. Highly
Congrats on the chart book. Everyone's got to check it out. It's on our homepage.
Yeah.
44 charts.
Josh, appreciate it. Thanks. Guys, coming up, General Motors CEO Mary Barra sits down with Yahoo Finance to talk tariffs, China operations, and what's ahead for the EV market. That's next on Morning Brief.
General Motors out with better than expected results and rather upbeat guidance. Let's welcome in GM Chair and CEO Mary Barra, along with our auto correspondent Praz Subramanian. Mary, always nice to snag some time with you. Big year for your company. You know, you really brought that to life in your letter to investors here this morning. But I think there's going to be a lot of focus on this guidance given everything going on in this world. And really two words stood out to me on this earnings release. You all are expecting a stable policy environment this year against a backdrop that kind of seems unstable. I mean, what gives you the confidence to put something like that in the earnings release?
Well, first I want to start and comment on 2024. I couldn't be more proud of the GM employees and then our partners, our suppliers and our dealers that helped us deliver such a strong 2024. And it all starts with our product, both our internal combustion engine and our EV product. So as we look to 2025, we think we can build on that strong foundation. It's what we do, build great cars, trucks, and crossovers. And so that's what gives us confidence. When we put our guidance together, there is so much talk about what might change from a regulatory perspective, from a tariff perspective, what happens from an IRA, that we said, assuming a stable policy environment, that's the results we think we can deliver. Now, we know there's going to be some changes. We've done a lot of scenario planning, and we know the levers that we can pull to minimize any impact. But, you know, having the opportunity to talk to the president, I really believe he wants a strong manufacturing sector because it's good for the economy. And so we're going to continue to focus on making sure the administration understands the implications of some of the decisions that they're considering. But I believe over the mid to longer term, there's a focus on strengthening manufacturing in this country.
Mary, when you had the opportunity to talk to President Trump, did he understand that a tariff might impact demand for autos? I mean, how do you frame a conversation like that and get the point across saying, hey, this might impact American jobs and it might send car prices higher in this country?
Well, I think he very much understands exactly, what the ramifications will be, and I think they've been very clear that they want to make sure there's the right and balanced relationships with many of the different countries that they're talking about to accomplish the goals of his administration. But I do think he has a very good understanding of the implications of tariffs or changing IRA, the stringency from a standards perspective. I think he has a very good understanding of all of it as it impacts the domestic and U.S. auto companies and the overall manufacturing sector.
Hey, Mary, Praz here. So speaking of that domestic market, the EV business doing quite well for GM. You're hitting that variable profit target that you guys were talking about in Q4. Big deal there. How did you achieve that? Was it mostly a scale thing?
Well, scale certainly played a big role, although we had lower scale than we thought based on demand, because we are going to continue to balance production with demand. But I think there was a lot of elements, improvements from a battery technology perspective, looking at our vehicles and how do we not take away anything that would impact the customer, but how do we drive more efficient solutions? We've talked about winning with simplicity, and that actually allows us to go to market in a way that I think is better for the consumer because they're not having to make so many choices. So it wasn't one thing, it was a number of things, but scale's a big portion of getting to that variable profit positive.
Yeah, we just got out of that Equinox EV, pretty impressive for a car at $35,000. Also noting that GM is saying that you're going to hit possibly a tailwind of $2 to $4 billion in that EV business based on how things are going, based on the amount of cars you want to wholesale. How does the potential loss of an EV tax credit affect that guidance?
Well, we do think that there is a potential for EV demand to go down without the consumer tax credit or some of the other aspects of IRA. But remember, we started on our EV journey before we even knew IRA was going to be was going to be legislated. So we're going to continue on our journey to continue to take costs down, provide great electric vehicles as well as great ICE vehicles, but great electric vehicles that customers want to have. And we're seeing that because we're growing share on both the internal combustion and the EV side. So we think that that's going to allow us to maybe, in this case, take a larger share if there's a smaller EV market. And we'll provide updates through the year, but we definitely see savings with all the work that we're doing internally.
Mary, this is an administration really focused on boosting energy consumption or domestic energy consumption in this country via oil drilling. I mean, as you think about your production timelines, is GM going to be making gas-powered cars for longer? I know you really want to get to making more, really predominantly EVs by 2035, but do you see yourself as mostly a gas-powered car for the next couple decades?
Well, we have said that we have plans in place to have all of our light-duty vehicles be electric by 2035, and so we have a plan to accomplish that if that's where the consumer is. But we also have the opportunity to continue to make, new models of our great ICE portfolio, and we're really excited about our full-size trucks and SUVs, the new mid-size crossovers and compact crossovers from an internal combustion engine side. So again, our portfolio gives us the opportunity to give consumers choice, and that's what we're in the business of doing.
Hey, Mary, so looking sort of internationally, in particular China, that business sort of going through a transition there. I know you guys took a big charge in Q4, but then also I'm noting that there was some positives that happened in the business there. What's your outlook on China, and how do you compete with those really efficient automakers?
Well, I think we have the opportunity as we work with our partner to implement the restructuring plan to get our capacity in line with what the demand is, to get our inventories. That's really what drove a lot of the opportunity to get to equity income positive in the fourth quarter. And so as we continue to execute that plan, we're looking for China to return to profitability this year. And we think we're going to be set up to participate in what is the largest market and has growth potential as we get to the medium term. And we think we've got the right portfolio and we'll get the right structure of the business. So that's been important work that we put into place in fourth quarter and will continue to execute throughout this year.
Mary, real quick before we let you go, on the EPS guidance for this year, if there is any form of tariff, does GM fall below the bottom end of that earnings range, or how should investors think about it?
Well, again, without knowing exactly what the tariff will be, how long it's in place, or what other changes come with it, we provided guidance based on what we know today and what the environment that we know today. So that's what the guidance is. And, I think what we've demonstrated over the last many years, though, is an ability to be agile and flexible and adjust. And we're going to stay focused on delivering the financial results to make sure that we're doing the right thing from a business perspective and for our shareholders.
All right, we'll leave it there. GM Chair and CEO Mary Barra, always nice to get some time with you. Appreciate it. And thank you to our very own Praz Subramanian for joining the conversation.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, let's talk about JetBlue, narrowly beating revenue estimates in the fourth quarter, also reporting a narrower than expected loss per share of 21 cents versus the 31-cent loss that was expected. The company's Jet Forward strategy, aimed at helping the airline become more financially stable, contributed $90 million to earnings before interest and taxes for 2024. The company's CEO says 2025 will be focused on executing Jet Forward and building on the prior year's momentum.
Plus, Royal Caribbean posting a strong profit outlook for the year, seeing adjusted earnings per share in the range of $14.35 to $14.65. Fourth quarter revenue coming in line with the street's expectations. Now, the cruise line saying that wave season, the busiest time of year for the company, is off to a record start with bookings. And the company announcing plans to launch a celebrity river cruise business in 2027.
And SAP beating on the top and bottom line in the fourth quarter, helped by the software company's new AI capabilities. Cloud revenue for 2024 in constant currencies grew 27% from the prior year. 2025's cloud revenue outlook was lifted from prior projections. This comes as SAP looks to use AI services to entice clients to shift from legacy servers to cloud-based IT infrastructure. Shares right now are lower.
All right, we'll keep it right here on Yahoo Finance. That does it for us in the morning brief. But Catalyst is coming up next. Much more analysis on the other side. Welcome to Catalyst. I'm Shauna Smith alongside Alexandra Canal. We're 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we break down the market sell-off and if fears of a bigger meltdown are overblown.
Plus, we bring you the latest read on consumer sentiment and get the outlook for rates as the Fed kicks off its two-day meeting in Washington.
And a big day and a bigger week for earnings. We'll bring you the key themes to watch from the defense sector and get a preview of Tesla's results.
All right, we're just about 30 minutes into the trading day. Let's take a look at the three major averages because it has certainly been, I'm going to say whipsaw, volatile morning a little bit, as we certainly have seen the major averages fluctuate just a bit. As it stands right now, you do have the S&P and Nasdaq both in positive territory. You've got the Nasdaq up just about 0.4%. Remember, this is a bit of a rebound from yesterday's 3% drop. You do have the Dow, though, reversing some of yesterday's gains in the red here this morning. NVIDIA, though, that is one of these stocks to watch, if not the stock to watch here in today's trading day. Right now, it's up about 1.5%, well off the highs that we saw earlier this morning. But again, it is a bit of an improvement, a significant improvement from what we saw yesterday. That stock closed off just about 17%, wiped about $589 billion off of its market cap, a record there. So again, lots of questions about DeepSeek, what that introduces in terms of cost-wise, if that's going to have big tech reevaluate some of their AI spending plans. That certainly sent ripple effects and some concern throughout the market yesterday. But Ali, the big point that we wanted to draw attention to was the concentration that we saw in terms of yesterday's selling. And I think that's very much illustrated in today's early action. It was also illustrated in where we closed yesterday with the not only major averages, but once you take a look underneath the surface and take a look actually at some of the outperformance that we continue to see.
Yeah, and to that point, the S&P equal weighted index actually closed in positive territory, and that's a sign that we saw a bit of a broadening out there, despite the fact that NVIDIA and some of those big tech names had a major sell-off. The Dow also closed in positive territory. It was boosted by Apple, which had its best day in 4 months. We're also seeing Apple shares continue to move higher today. Financials closing at a record high, a slight dip shortly after the bell today. Small caps and mid caps, they're currently outperforming the S&P on a year-to-date basis, and we had that much-needed drop in the 10-year yield. Probably still more room to run there, still a little hot, above 4.5% on that yield. But again, we're seeing this market rotation, this broadening out of the rally. That's not to say that tech is not important. It clearly is. The Mag 7 stocks are expected to grow earnings by 21.7% in the fourth quarter. That's compared to just 9.7% earnings growth projected for the other 493 tech stocks. And then we are expected to see a bit of a deceleration in the first quarter and then a reacceleration from the tech giants towards the end of the year. So it's clear that if we continue to see a big reversal in NVIDIA stock, if tech continues to lag, that is going to bleed into the broader market. But I think you can't take yesterday's pricing action as gospel at this point.
Yeah, and I think that's very much why we've seen a lot of the notes here from strategists over the last 24 hours, still relatively optimistic about that bull market picture, very much making the argument, I think consensus is that it still remains intact. Yes, this is something to be worried about. You talk about the sheer size of NVIDIA itself, but really tech overall accounting for about 30% of the S&P. So given that outsized influence, clearly that is one of the big reasons, or the big reason, that we saw the S&P close off just about 1.5% yesterday. Clearly, some of the pain was felt beyond big tech when you take a look at some of those utility names. Had also been high flyers among the AI trade, those getting a bit of a drop, just to say the least.
Yeah.
Significant decline yesterday. We're seeing some buying action, some of those names here this morning. But again, I think the question is whether or not the worst is behind us and how worried maybe investors should be about some of that selling in AI. Right now, it seems like, at least for now, many investors are shrugging.
And it was interesting to see the software companies actually see a boon, because that could potentially be a benefit if there's cheaper AI products on the market. So lots more to discuss. But for more on the dramatic moves we've seen in markets so far this week and a possible rotation out of large cap growth stocks, we have Keith Buchanan. He's a senior portfolio manager at Global Investments. So Keith, we were just talking about some of the recovery that we're seeing today, some of that broadening out of this rally, but the concentration that we've been talking about in tech that did expose some of the cracks in this market. So for you looking ahead, is that a risk to the bull run?
Well, absolutely. And thanks for having me. We've done a lot of work around the subject. It's been a core of some of our transactions here over the past 12 months. As we've been inching out of large cap growth, especially the spaces within that space that have really exploded when it comes to demand for the shares and the move up in some of those names. We've looked at it a couple of ways, but the dislocation has really been the most concerning part as far as how we look at valuations of those few names, particularly, Mag 7, to use the overused mantra, but names that have been levered to the AI trade. And when it comes to our allocation and how we allocate capital across the world, we've moved away from preferred habitat of years of large cap growth because we feel like that dislocation in valuation really made some of those names, particularly those that were up the most, very vulnerable to any type of shocks that might cause any concern or debate around the ramp of demand, as well as the supply that can meet that demand. And we saw both of those kind of collapse yesterday with DeepSeek. We didn't anticipate that particularly, but just felt like that vulnerability presented a risk that we didn't want to really expose our clients to coming into year end.
So Keith, and how critical are the earnings reports that we're going to be getting over the next several days, just in terms of whether or not it's going to calm some of that fear that certainly has been introduced to the market at this point?
We think it's incredibly critical to the path of stocks going forward, particularly for the first half of this year. As we combine not only, now we have questions or concerns or at least a debate around how quickly and how competitive the landscape will be going forward. We also have high rates, even though we had a pullback yesterday. 4.5% on a 10-year puts increasing pressure on equity valuations, particularly those with the highest duration, which are these names that have the highest ramp in the further out years of any DCF, discount cash flow model. So as we're looking at this earnings season, you can do a couple of things. It can disappoint, and the expected growth of 11% for the fourth quarter, 14% for 2025, could really add yet another risk to that valuation of the S&P 500, which is driven largely by, again, those larger, higher growth, technology-oriented companies. Or it could outperform, which landing above 11% on the fourth quarter and having guidance that ticks the 14% expected from a bottom-up standpoint, even higher, perhaps in the mid to higher teens. That will give a little more breathing room to stocks as that valuation doesn't have to continue to carry the day, and earnings can, on a more widespread basis, push that the indexes higher and give a little more leeway to upward momentum to continue through the first half of 2025. So we think this earnings period is extremely critical in setting the stage for 2025 and how much pressure valuations could potentially be under in the first half.
And Keith, I want to pick up on that valuation point. Like you said, tech is very expensive. That's been driven by AI, but the ROI is a little uncertain right now. So while the AI trade is certainly real, it's also speculative. So how do you position yourself within a speculative environment to really balance those risk rewards?
We've been doing just that, just balancing the risk reward by making sure we're diversified across our U.S. equity exposure. Now we're more balanced we bought more in the top 200 value. We're also not biased towards U.S. growth at all at this moment. We're more balanced for growth to value. Still prefer U.S. over international, but we've just had to spread our risk. And we feel like, and you see from an earnings standpoint, you dig into the S&P 500 and what's driving the growth in the S&P to the 14% expected growth in 2025, it's been the rest of the 493 stocks. We're finally getting contribution from other space, and you kind of see that with the banks as they had a really robust earnings period earlier, a couple of weeks ago, and we're getting into some of the more meat and potatoes, traditional industrial type of names that have reported decent earnings growth and have contributions that have taken a lot of the pressure off of the Mag 7. And we feel like that should reward those stocks and spread out some of the performance that we've seen just concentrated in just a few stocks.
All right, Keith, great insight. Thanks so much for taking the time to join us here this morning.
Absolutely. Thank you.
The Conference Board's January consumer confidence just crossing the wires, declining here to a reading of 104.1. The President's Situation Index Consumers Assessment of current business and labor market conditions actually fell sharply in the month of January, dropping 9.7 points to 134.3. For more on this, we want to bring in Yelena Shulyet-Yavit. She is a senior U.S. economist at the Conference Board. And Yelena, it's great to have you here on Yahoo Finance. So consumer confidence here for the most recent reading, disappointing just a bit. It's actually the lowest level that we've seen since September. What is this indicator? What does this signal to you?
Well, the index declined for the months, but the previous months was revised upward quite substantially. And, quite frankly, the index has been moving in quite a narrow, stable range since 2022. So that basically tells me that consumers are still feeling okay about the economy. They continue to spend. And, if you compare the level of the index to the values we saw back in 2024, last year, when consumers were really spending pretty well, you can assume consumers will continue to do the same going into this year.
So what's driving some of that disappointment that we saw in the confidence numbers? Is it uncertainty over the political landscape with Trump now in office? Is it further fears over inflation? Is it what the Fed does? What was the main drivers here?
A little bit of everything, probably. We saw all 5 major subcomponents of the index decline in the months. But I would say that inflation remains quite a significant concern on everybody's mind. All consumers are worried about it. And after such a tremendous increase in inflation that we have observed in the post-COVID period, it's very much still on their mind. So for me, what it really means, what it really matters from this report is to see how much inflation expectations will remain stable. They are stable now, but there's a lot of policy questions that remain quite uncertain what the answers are. And we will see in the next few months how it gets resolved. For now, there's a lot of uncertainty and consumers are probably worried about it.
Yelena, what's your base case for what the Fed will likely do or how it will likely address some of these inflationary concerns at this point?
So we think the Fed will remain on hold, at least in the first half of this year. We have 3 rate cuts in the second half of the year when the situation, gets cleared a little bit, hopefully, in our view. But for now, it's very difficult to say what inflation outlook will look like. You have potential tariffs, potentially as early as this coming weekend. And on the other hand, you have a little bit of a slowdown in the labor market. It remains healthy by all measures. Don't get it wrong. But at the same time, companies will probably not need to hire as many workers as they had to in the wake of the pandemic. So growth in real disposable personal income will continue to slow down, and that will probably pull growth in consumer spending down a little bit. So the economy is slowing down, and we think that by the end of the year, we will see growth slightly below of the robust reading that we expect to see on Thursday.
So your base case is a hold. Markets agree with you, nearly 100% chance that the Fed holds rates steady. So what are you looking for out of Jerome Powell when he takes a stand in that press conference?
Well, unfortunately, probably not much from the press conference itself. But to me, what really matters is how much they are incorporating expectations for policy changes into their projections, into their thinking about how inflation will evolve. So, the data are cooperating. Probably the reading on personal consumption expenditures price index will be quite consistent with the 2% inflation target if you just look at the monthly reading that we will get this Friday. But at the same time, we really don't know how much these policy changes will affect inflation outlook. So the data is the data. The Fed is data dependent, great. But how much are you incorporating all these policy changes into your outlook? We know from the previous press conference that some policymakers did make some assumptions, but it was not everybody. So a little bit of clarity on that question. But I don't know how much he will be able to reveal in the press conference.
Yelena, we certainly will see when we hear from Powell tomorrow. Thanks so much for taking the time to join us here this morning.
My pleasure.
Coming up, defense companies RTX and Lockheed Martin out with results. We'll break down the full year outlook and what analysts expect for the space. That's coming up right after the break.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Aerospace and defense stocks are out with earnings here this morning amid speculation around the Trump administration's defense spending plans. Two of the biggest names in the sector reporting results here this morning. You have RTX and Lockheed Martin. Now, both of these names have an average buy rating from analysts on the street. That's according to the data compiled by Yahoo Finance. You can see the two names moving here this morning. You got RTX shares up just about 3.6%. Lockheed, on the other hand, those shares falling about 7.5%. But first, let's focus on RTX, because certainly when you take a look at what we're hearing from the company's investors, very much shaking off some of that muted guidance and focused on the company's quarterly profit beat. Analysts seeing a bit more upside actually from here with the stock in the months ahead. A couple of catalysts on the radar here from analysts that we are tracking, saying one is Pratt & Whitney unit. That could actually see a boost from strong demand for spare parts and engines. Also, higher defense business spending in the U.S. and in Europe could also keep some of that stock's momentum alive. So again, a couple of catalysts here to keep on your radar when it comes to RTX. RTX also making it very clear that it is prepared to support President Trump's push here to create a missile defense system, which the president has dubbed as the Iron Dome for America. Now, in an interview this morning with Bloomberg, RTX's CFO saying that the company was exceptionally good at developing similar systems, having experience with Israel's Iron Dome. Now, let's take a look at shares of Lockheed, because on the other hand, that stock is actually falling here this morning. You're looking at losses of just about 7.5%. The move lower that we're seeing is on the back of those weaker than expected results. Net sales, they missed. Its missiles and fire control unit actually posted a loss of $804 million. Its free cash flow falling 73% from just a year ago. Now, when you take into account that bleak outlook and some of the worrisome trends that we are seeing within Lockheed's business, it's actually prompted investors and prompted Wall Street pros to lower their expectations on the stock. RBC dropping its price target this week on the stock from $665 down to $570. So again, a bit of an upside from where we are trading currently today. They still have that outperform rating, but lowering those 12-month expectations. Let's take a look at the performance that we've seen of this sector more broadly and compare it to what we have seen from the S&P. And you can see it right here on your screen. Year to date, you're looking at the blue line. That is aerospace and defense. That is actually up 6% since January 1st. Compare that to the broader S&P 500. That's up about 2.5% year to date. So we have seen a bit of an outperformance here from the aerospace and defense sector. More than 70 companies, to put this all in perspective, make up the sector, a combined nearly $1.2 trillion in market cap. Again, 74 companies make that up, and that year-to-date performance certainly outpacing the broader market gains. And you can keep tabs on all of these names within the aerospace and defense sector with the help of our Yahoo Finance sector view. That's Yahoo Finance tools on yahoofinance.com. Allie.
Thanks, Shauna, for that. Well, President Trump signed several executive orders late Monday to reshape the U.S. military. Among the measures, paring back DEI initiatives and a mandate to create the Iron Dome for America, a missile defense system similar to Israel's. Joining us now to discuss is Chris Kirchhoff, the Pentagon's Silicon Valley office founder and author of Unit X, How the Pentagon and Silicon Valley Are Transforming the Future of War. So, Chris, what do the latest executive orders mean for defense spending, and how are companies like Lockheed and RTX, which Shauna was just noting, how are they positioned within a Trump 2.0 political environment?
Well, we're at a really dynamic moment with the Trump team coming in, taking the reins, and beginning to pursue their very bold agenda. And they're being consistent in the sense that we have seen some dramatic executive orders out of the Trump administration. For instance, the federal hiring freeze, the stop work order on foreign aid. But these don't affect national defense. The defense portfolio remains so far untouched. So I think we're going to see very aggressive action in the coming days and weeks from the Trump team.
So what does that mean for these defense stocks, just in terms of the upside, how big of a boost maybe this will provide to some of these names?
Well, I think it's going to be a boost on the whole. I mean, we just had yesterday the chairman of the Senate Armed Services Committee, Senator Wicker, come out with the view that an additional $200 billion should be added to the reconciliation bill currently under discussion today in Miami, Florida at the Republican conference. So I think we're going to see broad increases across the board for both traditional weapon systems and new entrants.
Now, the defense budget has doubled over the past decade, but analysts have warned that we could see some turbulence under this new administration, especially if you think of things like the Department of Government Efficiency, otherwise known as DOGE. So what's your outlook and really maybe some of the risks there?
Well, I think the risks are mainly political in the sense that there really is broad bipartisan support for transforming the department on a lot of important points that were outlined in the Trump team's vision in Project 2025 and Secretary of Defense Pete Hegseth's opening statement. They want to increase lethality. They want to take on hypersonics. They want to make the most of space. And they're now doing these things. So this is a really exciting moment in the sense that we have a lot of new entrants like Anduril, like Palantir, that are coming to the market with products that are directly responsive to the new vision that's being articulated. But these are companies that, by and large, have not yet scaled products to say what a Lockheed or a Lockheed or Boeing can do with platforms. So it's going to be really interesting to see what happens in the coming months.
You know, Chris, that's a great point. I guess from your research that you've done and those that you've been talking to within the industry, to what extent do you expect that to reshape just the industry at large?
Well, it's a big open question. So the new entrants in defense don't necessarily have the manufacturing expertise that some of our traditional primes do. And so when the contract amounts get to a certain size and they're expected to deliver a certain unit quantity, they may require more help to get their products to scale. And this could mean potentially, as time goes on, more partnerships between new entrants that so far have been very hostile to the traditional primes. But you could imagine them partnering to scale the products they're developing.
And to follow up on that, Chris, where exactly does the demand lie right now?
So I think the Trump team has been very clear. Hypersonics are a whole new generation of weapon class. That's what you see the executive order on Iron Dome for America related to. Readiness is another concern. But we're really, after Ukraine, after the conflict in the Middle East, seeing a whole new spectrum of technological threats, from autonomous weapon systems, from drones, from more advanced cruise missiles. These are new weapons that threaten a lot of our legacy weapons platforms. So the United States military has a lot of catch up to do.
All right, Chris, always great to speak with you. Thanks so much for taking the time to join us here this morning.
Thank you.
Coming up, how looming tariffs could hit the auto industry. That's coming up next on Catalysts.
I think he very much understands exactly, what the ramifications will be, and I think they've been very clear that they want to make sure there's the right and balanced relationships with many of the different countries that they're talking about to accomplish the goals of his administration.
That was GM CEO Mary Barra speaking on President Trump's tariff plans during an interview with Yahoo Finance. Now, her commentary following GM's fourth quarter results that beat expectations raised its 2025 profit guidance. We initially actually saw the stock tick higher on this update, but again, you're looking at shares falling just about 9%, the biggest drop that we have seen since March 2020, clearly failing to impress the street amid some of the risks surrounding GM. Let's talk about that and more. We want to bring in John Murphy. He's Bank of America's managing director. John, it's great to have you here. So when you take a look at that 9% drop here this morning, what is behind that move, and how worrisome is it to you when we think about some of these risks, including tariffs?
Great. Well, thanks for having me. And when a stock's down this much, you always get a little bit worried, but try to figure out why it's happening. As you mentioned, sort of in the lead-in here, is the results were pretty good. 2025 guide is better than consensus right now, largely in line with, I think, buy-side expectations, and at the midpoint, just a little bit lower than our more optimistic outlook. So the financials, as they are being presented, look pretty good. But I think, as you mentioned, there's policy uncertainty around tariffs, potentially even more importantly around EV policy, around IRA incentives, the $7,500 consumer incentive and commercial incentives, as well as what might be going on with the CARB ACC2 or the EV mandate in California and the states that follow them. So I think from that standpoint, there's some real uncertainty, and it's very difficult to predict which way those will go. But also say, from a mix standpoint, folks are a little bit concerned there'll be negative mix this year or potentially pricing pressure. And I think the third thing to really think about here is that GM has benefited from a very aggressive buyback through the end of 2024. And the current share authorization or buyback authorization is fairly slim. There's not that much left. So I think that is something that's giving some folks a little bit of agita, because they're going to have really strong free cash flow, $11 to $13 billion this year in free cash. So they should be able to deploy a lot of that to share buybacks. But there hasn't been a specific direct commitment, because I think they're uncertain about what's going to happen in the industry as well.
John, real quick to the policy point that you just made. Is GM a little bit too quick to dismiss some of these risks, do you think?
Well, I certainly don't think Mary and the team are dismissing the risks at all, and sort of the variability of which way this will go. I think ultimately this could potentially break very positively for them, particularly around some of the EV mandates in these CARB states, and tariffs probably will be much smaller than feared at this 25% tariff on Canada and Mexico, but we'll see. So I think the ultimate outcome will probably be reasonably constructive for them, but they are certainly not dismissing these whatsoever.
Not dismissing them, but when they did raise guidance, they said that they're assuming no tariffs or tax policy impact. So it feels to me, given by the stock reaction, that investors think there will be some sort of impact. So how significant do you think that could hit that guidance? And do you think that's the main driver here, why we're seeing such a drawback in the share price?
Well, when you look at Canada and Mexico, the 25% tariff on Canada and Mexico that's being discussed by Trump, ultimately, that probably hits about 20 to 30% of their North American production. So that would render that production not profitable. But the reality is there's options to increase production in the U.S. because they have some excess capacity, and to ship some of those vehicles that are being produced in Canada and Mexico outside of North America to avoid those tariffs. So I think there's ways to deal with that to some degree. But if the EV mandate in California goes away and we see a relaxation of EPA emission standards, the reality is the ICE business, their trucks, where they make all of their money, could potentially be far better off, and you could see higher volumes there. So there's a lot of yin and yang to this, positive and negative, that you really need to take into account. And I think the reaction today is pretty overblown.
Yeah, that's certainly. I was just going to say, it almost sounds like you're saying that this is still a step in the right direction here for GM.
Ultimately, the results are a step in the right direction. Yeah. I think the guidance is a step in the right direction. And I think the policy in its various layers could break sort of neutral to potentially positive for them, ultimately, when all is said and done.
John, you also covered Tesla. You recently downgraded the stock from buy to neutral. You said that the valuation has captured much of the long-term potential. Is that the only thing keeping you on the sidelines, or do you see other downside risks?
Well, listen, there's many factors driving Tesla stock from fundamentals to technicals to sort of rotation in the market from the Mag 7 to out of the Mag 7 and higher beta stocks. The reality is we had a pretty decent upgrade in April of last year. made a lot of money for investors. We're happy to take a little bit of money off the table, take a step back here. Our sum of the parts analysis indicates that there's a fair value somewhere close to $490, plus or minus is our point estimate there. So as the stock was getting into the low 400s, risk adjusted, after having a run from about 160 when we upgraded it, we thought it was time to go to a neutral. Ultimately, I think Tesla is a very interesting story, and the real big swing factor there is going to be full self-driving, where they seem to have a bit of a lead on the advancement to autonomous over everybody in the market. And I think that's really going to be the thing that we need to watch this year to figure out whether we stay neutral or maybe we get back on the buy.
John, I'm curious what you mean of the fact that Tesla was kind of caught up in the selling that we saw yesterday in relation to DeepSeek. What does that tell you?
Well, listen, I think there's a lot of tech investors involved in Tesla. In some ways, there's some technical rotation and stuff that are going on there with the stock. But also, Elon is the third largest consumer, or Tesla, I should say, not Elon himself, but Tesla is the third largest consumer of NVIDIA H100s, I think, with a cluster of 50,000 H100s and growing as of towards the end of last year. So they're the third largest consumer. So, they are buying a lot of hardware to ramp up their AI, which will be necessary for FSD and ultimately autonomous driving to really, really work. So the reality is if somebody could potentially do that cheaper, more efficiently and faster, that could eventually create competitors to Tesla in this road to autonomy. But we'll see. But maybe that was part of what was going on there as well. But it's a high beta sell-off, and clearly Tesla's a high beta stock.
And China has been a difficult area for a lot of these automakers to really conquer, especially when you think about the pricing wars happening over there, not just Tesla, but also GM. With the threat of tariffs looming, how do you view China and the market position within China?
So it depends on the automaker that you're talking about. I think the incumbents, particularly the domestics of GM and Ford, ultimately need to really reassess their strategy there and exit the market, because they are truly American companies. And like most major markets in the world, China is going to favor its domestic manufacturers. So I think their competitive position there is at extreme risk, and they're really not making much money there anyway. I think Tesla and Elon's ability to navigate the political environment, as well as be at the leading edge of tech, whether it be EV or AV, will allow him to operate over there fairly well. But remember, they're just getting sort of the acceptance for FSD to be launched over there. So on autonomous, it might be challenging for him to really break through and be competitive. But we'll see. But he seems to be navigating this far better than the rest of the industry, and is viewed as a quasi-global company, particularly by the Chinese and the U.S. government. So I think he'll be able to navigate better than the other international companies.
John Murphy, thanks so much for your insights. Appreciate it.
Great. Thank you.
Coming up, we bring you the outlook for Bitcoin and speak to one investor who isn't so sure about a strategic Bitcoin reserve. Details to come after the break. Bitcoin is back above $103,000 this morning, recovering some of its losses from Monday's risk-off sell-off. Our next guest says that Bitcoin's current rally could be in jeopardy. Here to discuss is Anthony Georgius, founder and general partner at Innovating Capital. So Anthony, the bulls have been out when we talk about crypto. Why are you bearish on the recent run-up in prices?
Definitely. Well, I think generally speaking, we're seeing obviously a lot of risk-on sentiment. Things are priced to perfection. We're seeing that obviously with NVIDIA and obviously a lot of the AI fears around DeepSeek and what that might mean for obviously a number of incumbents and key clients who are putting billions into CapEx spend surrounding that. I think the same goes for Bitcoin as well. It's not to say that I am skeptical or anti the crypto progressive regulation that we're seeing, but I think it's one of those things where we need to be careful what we wish for with respect to things like a strategic reserve and certain legislative oversight.
So then what does that downside look like?
I see the downside less in terms of impacting Bitcoin in particular and more pertaining to other altcoins. Specifically Ripple. There's a lot of positive sentiment in the market for Ripple right now and a lot of excitement around Ripple as potentially a strategic reserve. But I see a lot of fundamental flaws in XRP in particular, and honestly view a strategic reserve backed by Ripple as being the demise of the network itself for a number of reasons.
And going back to Bitcoin, do you think we've reached the top of prices?
So we're very, very much so long-term holders of Bitcoin. Price targets, well in excess of 7 figures and 7 digits, right? Where Bitcoin is today, if you look at just from kind of a short-term perspective, I do think that the market has priced in a lot of the positive catalysts over the last several months, and there's still a lot of risk-on behavior tied to Bitcoin as an asset. We saw yesterday the sell-off in AI and tech assets in general, and what that did to the price of spot BTC. Generally speaking, I think the market's priced in a lot of potential friendly regulation and the probability of certain catalysts like a reserve taking place, whereas frankly speaking, the underlying fundamental behavior for a lot of that to actually make its way and permeate through the market, it's going to take years.
And let's talk a little bit about RXP. You seem to be hot on that issue. Certainly, we have seen a massive surge, to say the least, up by 50+%, I believe, since the start of the year. When you talk about worrisome signs here, why you are a bit concerned, lay that out for us.
So it really goes back to the fundamental behavior of how Ripple itself operates. XRP, the token, runs on the XRP ledger, a decentralized ledger of sorts, which has largely been scrutinized for being controlled and manipulated by Ripple Labs, an independent organization that I somewhat view as smoke and mirrors. Ripple Labs maintains a lot of influence over XRP, particularly how networks are validated by selecting a node list of validators that process all transactions. And most participants in the network use Ripple Labs' default node list. So what does that really mean? Why does that matter for all of this? I actually view this kind of weakness and fail point in the centralized aspects of Ripple as really being why the government would even consider it to be a key candidate for reserve, because they could actually purvey mass regulatory overreach and influence to ensure that any transactions that occur on the Ripple network itself comply with all U.S. regulations, comply with all nation-state laws. They may ban particular transactions from particular institutions or nodes domiciled in particular geographical regions. And that fragmentation of trust will really lead and ultimately result in a large breakdown of the network itself, potential forks, loss of network value. And then it just kind of begs you to ask the question, what's the point of this decentralized token at all? It's not going to compete with Visa in terms of speed or performance. It's not going to compete with anything that we know from a centralized perspective, but yet it will become a captured network in that respect. So I view it as a quasi-centralized token that doesn't necessarily have fundamental competitive strengths with existing centralized projects, and by no means has a place in a decentralized ethos.
All right, Anthony, thanks so much for your insight here this morning. Coming up, we're taking a look at some of today's top trending tickers, including Starbucks ahead of its quarterly results. We've got that look ahead for you when we come back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Visa. It struck a deal with Elon Musk's X to launch a digital wallet and peer-to-peer payment service. The social platform's deal with the largest U.S. credit card network was just announced by CEO Linda Yaccarino, CEO of X, in a post on platform. So the significance of this, we've heard for time and time again, Ali, that Elon Musk wants to make X that everything app. He said that when he first acquired what was then known as Twitter a couple of years ago. So now this is a first step. And ultimately, to me, what I can make sense of so far, that it sounds very similar to maybe what you can do on Zelle or what you can do on Venmo. So a significant first step here for X. It will be interesting to see what those future partnerships look like. Apparently, they are licensed in 41 states, also registered with the Financial Crimes Enforcement Network up until this point. And this is, again, set and expected to launch here within the first quarter.
Yeah, and Visa shares, they're up just slightly today. I mean, they're a huge partner for X, especially if they want to try and pursue this. Linda Yaccarino saying that you can securely and instantly fund your X wallet via Visa Direct. It connects your debit card, allowing those payments option to instantly transfer funds to your bank account. And it's the first of many big announcements here. I am a little hesitant if people are going to buy into this. I still have friends who don't go on Venmo because they're very worried about the security of it. Some of them have actually gotten hacked.
Yeah.
So I think that is going to be a hurdle for X to overcome, especially since, you know, it's this social media site. Do you trust your money on that? I'm not quite sure if enough people will, but perhaps I'm wrong.
Yeah, and I think also just a sheer appetite for it, just in terms of how much people who are already using those other avenues, whether it's Zelle, whether it's Venmo, whether it's something else, PayPal, whether or not they see a need to do this as well. I think that is the big question.
It's a new normal too, right? I mean, I don't know what I would do without my Venmo app. I just Venmo'd someone this morning. So there you go. Next, we're talking tech companies. They are once again in the crosshairs of European regulators. A UK group has recommended investigating Amazon and Microsoft for alleged anti-competition concerns in cloud computing. The authorities saying Amazon Web Services and Microsoft's Azure each have about 40% of the UK cloud market. Meanwhile, Google facing the European Commission in the EU's highest court today over a $4.5 billion fine issued in 2018 for allegedly using market dominance to push traffic from Android devices to Google. So yet another hurdle for big tech across the pond. Now, in response to the competition concerns, an AWS spokesperson did say that the agency's recommended intervention is, quote, not warranted, saying that the evidence demonstrates the IT services industry is highly competitive and that cloud computing has lowered costs for UK businesses with expanded service offerings and more product choices. And look, the UK government really wants to spur growth. This independent agency saying these companies hinder growth, that it stifles innovation. But when you think about the market right there, I mean, Amazon is number one, Microsoft's number two. It is harder for these smaller vendors. A final decision is going to be published by August 4th, so we still have a few months to go. But it does seem like the EU has been pretty aggressive on targeting some of these companies.
Yeah, it certainly has. The EU, the UK. We look over across the pond and see some of the more aggressive behavior that we have seen from regulators. And I think this comes at a time where it's very much in question what exactly that regulatory landscape is going to look like here in the U.S. When you take into account the incoming administration, you can argue in some parts that, yes, they will tend to be a bit heavy and a bit more strict when it comes to big tech, especially when it comes to some of those monopoly fears, some of the competition questions that have been raised and were raised under President Trump's first administration. But again, this just points to the fact that they continue to be in the crosshairs, not only here in the U.S., but obviously very much over in Europe and the UK. That has been the leader in some of the crackdown that we have seen in big tech. And I think the question is, and very much it has been dismissed, I think, in large part by investors up until this point, and even by analysts. It hasn't really been a real concern just in terms of the material impact that it could have on their bottom lines and on their business. But again, if you do see, if this is a start of something that's a bit wider and you do see this continuing to grow, then I think it does become more of a concern for investors in the longer term.
Yeah, and more of a concern domestically too, right? So that's all something to continue to watch.
All right, let's take a look at Starbucks. It's set to report fiscal first quarter results today after the close. Yahoo Finance's Brooke DePalma is here with a closer look at the top three things that analysts are expecting. Brooke.
Good afternoon, or good morning rather. I'm thinking of today already. This is Brian Niccol's first full quarter under his belt as the CEO of Starbucks, having a long stint at Chipotle. And so investors are really optimistic that they will see a slight improvement in foot traffic as Niccol really doubles down on this back to Starbucks plan that he introduced when he started back in early September. Same-store sales and foot traffic are still projected by, according to Bloomberg estimates, to decline mid-single digits as the company really returns that focus to coffee, better pricing, and faster service. Now, what investors want to see is a bit of a turnaround in the U.S. business first. One analyst telling me that if we see a turnaround in the U.S. business, then all other pieces of this very complicated puzzle right now will fall into place. And we've seen major investments into the North American market by Niccol. That includes a new ad campaign featuring the return of those Sharpies. That also includes the return of the condiments bar, getting rid of extra charges for non-dairy milk, in addition to returning ceramic mugs at locations and encouraging customers to linger. We also now have to be a paying customer in order to use Starbucks bathroom, part of their new coffee house code of conduct. And analysts also keeping a close eye on coffee prices and any commentary there. If you take a look at coffee prices, that's ticker KC=F, they're up nearly 80% in the last year. This commodity getting lots of focus from the street, but one analyst saying that the risk to Starbucks margins should be limited here. Bank of America estimating that coffee actually makes up about 22% of Starbucks cost of goods. And so it's likely that this won't be a huge hit to Starbucks margins, but something to keep a lookout for. We know that Niccol promised that he would not raise prices anytime soon.
A lot to look out for on that earnings call. Now, Starbucks also announced executive leadership changes. So what's new there?
Yeah, lots of Taco Bell executives coming to Starbucks. So Brian Niccol really tapping into his former Taco Bell life that he served out previous to Chipotle and bringing in executives there. So 2 new executives will join the team in early February. We have Mike Rams as Chief Stores Officer and Meredith Sandland as Chief Store Development Officer. Now, this is part of that Back to Starbucks plan. It's a new operating model here. In a letter to partners this morning, Niccol says they need a clear ownership and accountability and an appropriate scope for each role. With these 2 new roles, there also are 2 executives leaving. That includes the Chief Supply Chain Officer. That role will be backfilled. Sarah Trilling, North America President there, that role has been split into those 2.
All right, certainly a lot of things to watch here in this earnings release that we're going to be getting. And also, make sure you tune in tomorrow. Brooke will be speaking at 9:40 a.m. Eastern Time. Her interview with Starbucks CEO Brian Niccol. That's happening right here on Yahoo Finance following the results. Coming up next, it's Wealth. We'll see you tomorrow.
Stocks rebounding this morning after selling off on Monday. Shares of JetBlue were taking a look in particular. They fell more than 25% this morning after the company posted a disappointing financial outlook, forecasting higher costs and unit revenue below analyst expectations. The shift of the Easter holiday will reduce its unit revenue by 1.5% this quarter. Boeing shares moving higher as investors anticipate better days ahead. It missed on fourth quarter earnings and reported an annual loss of $11.8 billion. That's the largest since 2020 as it battled safety concerns, a 7 one-week strike and layoffs. And GM falling despite beating on earnings and boosting its profit guidance. Analysts citing uncertainty around EV demand and tariffs as potential headwinds. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, we'll talk about a wealth manager who's got some tips on how to invest during a sell-off. Plus, the Fed's January policy decision. Oh yeah, that's due tomorrow. We'll talk to a chief investment officer about 5 factors that they say could keep inflation higher than the Fed's 2% target. Plus, buying a car in 2025? Well, we'll discuss pricing. And here's some tips from an expert so that you can prepare for your next big purchase. All that much more during today's show. But first, let's take a look at some of the market action 90 minutes into the trading day. We're taking a look at the U.S. major averages, all in positive territory right now as stocks are looking to recover from a tech-driven sell-off yesterday. The tech sector is coming off of its worst day since 2020. Joining me now, we've got Matt Stuckey, Northwestern Mutual Wealth Management's Chief Portfolio Manager of Equities. Great to have you here. So how should investors be positioning themselves during a week like this as we came off the sell-off and the volatility that kicked off this trading week?
Oh, good morning, Brad. Thanks for having me. Look, I mean, I think, just yesterday's reaction in the markets gives you a flavor for some of the concentration that is in markets. And so if you're looking to navigate choppier waters like this, I think investors would be well served to embrace a little bit of diversification in your portfolio. There's a big investment universe out there outside of just U.S. large caps, which, if you look at just the top 10 names in that index represent 40% of the market cap. And as we found out yesterday, a lot of that performance is tied to the AI investment theme. So, looking at diversification avenues outside of just the U.S. large cap space, I think serves investors well for weathering this volatility.
What's a good kind of rule of thumb for knowing if you perhaps are overexposed or are over leaning into or too concentrated into the AI theme right now for those who are trying to look to add some more diversification, as you were mentioning?
Well, it's a good question. I think if you look at just something like the equal weight S&P yesterday, was actually up about 0.3% versus the overall S&P 500 on a cap weighted basis, which was down 1.7%. If you find your portfolio that was kind of skewed more towards that down 2% range, that means that you probably could embrace a little bit more diversification in your portfolio versus something a little bit more diversified like the equal weight or other equity indexes, which were down much less than what we saw in the S&P 500 yesterday.
It's a big week, not just for earnings, but also for the Fed meeting, first Fed meeting of 2025. And we're going to get a rate decision from the FOMC members, not expected to do anything. But how are you kind of weighing what the tone might be coming out of their meeting to kick off 2025?
Well, you touched on it there, Brad. We don't expect the Fed to cut rates at this upcoming meeting this week. But, looking at the tone, I want to get a good sense from the FOMC statement as well as Chair Powell's press conference on what they're looking for to kind of move back into this theme of disinflation. We had, stronger than expected inflation reports in the fourth quarter of 2024. And this past one that we got earlier this month on CPI did show us that maybe there is some green shoots as it relates to the overall trend of inflation. I would point to supercore inflation there, which is just services ex housing. That did print one of the lowest numbers that we've seen in the last 4 months. And I think the Federal Reserve is, hopefully in the press conference indicates that they want to see a continuation of that. And if that were to continue, then potentially, that could unlock further easing from the Federal Reserve. And if you look at kind of how markets are priced in terms of the forward interest rate curve, there isn't a whole lot of easing priced into 2025. A lot of that was removed in the fourth quarter of last year. And so in terms of kind of how a portfolio might respond to that, we've seen throughout the last couple of years, whenever more Fed interest rate cuts are priced into to the curve from a lower base, a broadening out does happen in the markets. And so we can look for those clues at this upcoming meeting to whether or not that's the similar thinking from the FOMC.
So does a broadening out mean small caps? Because it would sound like that is almost like a what's old in terms of what was supposed to be was the popular kind of thesis going into 2024. Once again, here at the beginning of 2025, again, one of the popular theses.
Yeah, this is interesting because it's a different setup versus where we started 2024 is where we sit in 2025. When we started 2024, you had market expectations of 6 or 7 cuts priced into the forward curve. And as we look at the situation today, it's just 1 or 2 cuts priced in. And so there potentially could be, an upside surprise in the number of cuts if we do get this disinflationary theme back into the forward curve. How that interacts with small caps, small caps are one of the most economically sensitive asset classes for most investors, and they tend to have an outsized sensitivity to also real interest rates, which, looking at the Federal Reserve's impact there, it is pronounced. Furthermore, one of the encouraging things that we've been seeing on the fundamental side for the case for U.S. small caps is an inflection higher in earnings estimates. That's something that's been absent the thesis the last couple of years. In fact, they've just trended sideways. But if you look at the last 3 months, they're one of the strongest areas for positive earnings revisions. I think that, combined with a potential for kind of further easing from the Fed if you get inflation to move in investors' direction, does create both a fundamental and a monetary reason for an allocation towards U.S. small caps.
Matt, just lastly, while we have you here and looking through some of your picks specifically, Salesforce is on that list. Why is that?
I think if you look at Salesforce today, it's an interesting idea, simply due to kind of where they sit across kind of the IT infrastructure for most of corporate America. And kind of with this, disinflationary theme as it relates to the announcement over the weekend with DeepSeek, the cost of inference of AI moving lower, that does expand out the opportunity set for a lot more customers of Salesforce to embrace artificial intelligence. And, we think Salesforce is in a prime position to kind of bring that from a product perspective down to their customers with some of the innovation that they're providing on the product side of things.
Matt, great to have you here. Great to get some insights this morning. Appreciate it. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-anchor, Shauna Smith, here in studio. First up, Shauna, we got to talk about this AMD. It's cut to hold from buy at Melius Research. The analyst citing the earnings risks for AMD due to competition from NVIDIA. Shares of AMD only fractionally lower, but we should mention it's fractionally lower on a day where the broader markets are trying to mount a comeback from yesterday's declines.
Yeah, certainly. And AMD was one of the names that was caught up with the selling pressure yesterday. When it comes to this specific call, though, here from Melius, what they're a bit worried about is some of that competitive pressure there from NVIDIA and what we could see play out here over the coming quarters. A couple of things that this analyst brought out when it comes to those earning risks. They said that they think that NVIDIA is going to increasingly, quote, come for them being AMD in both markets with their ARM-based CPUs. They also went on to say that they're increasingly concerned that custom CPUs and NVIDIA CPUs will cannibalize even more of the x86 server market longer term, even though AMD's current chip, and we've talked about this a couple of times, Turin, is actually doing relatively well. So their new price target of 129 is significantly down from the prior reading. They actually pretty much admitted that they were very late to this call, and you can see why on your screen right now. AMD shares over the last year have actually had significant decline. Compare that to the massive run-up that we've seen in NVIDIA. Still, with the drop that we saw yesterday, NVIDIA up nearly 100% over the last year, and AMD very much in the red. They're saying that they wish that they made this call or should have made this call 10 months ago, saying that they're 10 months too late here following the epic run that they did see prior to that. So again, very much concerned about some of the fundamental trends right now underneath the hood there at AMD, and very much specifically some of the pressure that they could see on their business as a result of NVIDIA.
Absolutely. Another major one that we're tracking here today. Next up, Victoria's Secret upgraded to overweight from equal weight at Barclays. The analyst Adrian Yee citing 3 fundamental catalysts the stock is checking off, including better promotions this quarter, consistent growth from Q3, and then sales outpacing inventory here. Her title for this one, Shauna, Upgrade to overweight, bringing sexy back.
Bringing sexy back. She's all about the new CEO that was appointed back in September, saying that she is the right person for the job. She has total faith that Hillary Super, who is that new CEO, is going to re-accelerate growth at Victoria's Secret and at the Pink brands. Clearly, this is a brand that has been struggling to regain some of that momentum. So some of the things that are working, or why Adrienne Yee is a bit more positive here on Victoria's Secret at this juncture, some of that has to do with the promotional activity and the trends that we're seeing there. Certainly, they have relied over the last couple of quarters on heavy promotional pricing there to get or to help clear some of that inventory. She doesn't think that is going to be one of the strategies that will necessarily need to be implemented here going forward. She said they will not need to be as heavily promotional as they have been in the past. The back to the basics approach also talked about the fact that this is going to help them return to that phase of being profitable and also margin expanding growth here. Clearly, two things that the street is very encouraged about or would like to see. She also talked about the product pipeline and that being a big catalyst here for Victoria's Secret in the longer term.
Shauna, appreciate the breakdown here on two of these names we're tracking during today's trading activity. We're in week 1 of the 2025 tax season, and it's time to start gathering those forms that you get in the mail, like your W-2, your 1099s, and more. And while you're putting it all together, you may think, why is this so complicated? And even, why am I even getting so much money pulled out of my paycheck? But the reality is, when it comes to taxes, Americans don't shoulder as heavy a burden as those in other advanced countries. I guess that's the silver lining here. Here to explain, we've got Yahoo Finance senior columnist Jenna Herron. Jenna, good to see you. Happy tax season.
Thank you. Back to you, I guess. Yeah. So I would say one way to measure our tax burden is by looking at how much of our tax revenue makes up of our GDP. And in the US, that percentage is about 25%, whereas the average for OECD countries is almost 34%. And then there are 9 European countries that are north of 40%. So we have a very low tax burden. What this looks like on a per person level is that a worker who makes the average wage in Europe pays almost $12,000 more in taxes a year than if they lived in the US. And a big reason for that disparity is something called the value added tax, or VAT, which over 170 countries worldwide use, but the US isn't one of them.
Right. And so can you expand on the difference between the VAT and then the US and our income tax system?
Sure. So the simplest way to think about a value-added tax, it's a very broad sales or consumption tax at the federal level. The tax not only applies to goods that you buy at the store, but also for services as well. So if you hire a contractor to do a home repair, in the US you pay him for his labor and for the materials used. But in countries with the VAT, you would also pay a value-added tax on top of that. So the VAT applies to much more in a country's economy and is typically much higher than a sales tax that we're used to. So it can range between 20 to 25%. And the result is that the VAT raises a lot of money. Now, in the US, as we know, our federal government collects taxes from us and from companies, and that's what they rely on to fund the federal government. And these taxes, income taxes, can be pretty low. So for those who make the lowest incomes, their tax rates are 10% or 12%. But we also have so many credits and deductions that even if you earn more, you can lower your tax burden. And some of that is offset by some of the highest earners in our country, which pay higher rates. We also have the benefit of having so many more higher earners in our country versus elsewhere. And then we also have corporations, very successful ones, paying into our tax system.
Yeah. So let's break down the U.S. state and local taxes and how that comes into play versus other countries.
Sure. So in the U.S., the federal taxes make up about 2/3 of our tax burden. State and local taxes make up the rest. Depending on the state, you may pay income taxes to your state or your city, like New York City, sales tax and property tax, which is a pretty big one. The reason that our states tax so much is because they fund 2 very big elemental programs: our teachers and education, right, and the police force. In other countries, it's the federal government that funds these 2 things, along with other programs such as universal health care, parental leave, higher education, child care, and elderly care. Whereas in the US, those kinds of expenses we pay as Americans out of pocket, And that's kind of the trade-off for having a lower tax burden.
Good breakdown there, Jenna. Okay, all right, we've got a lot of time left here in this tax season. Everybody can really kind of break down exactly what these systems mean for them, as well as we've all seen it show up in our paychecks. I appreciate it. Thank you.
Thanks.
Coming up, everyone, Yahoo Finance spoke with GM CEO Mary Barra this morning. We'll dig into some of her commentary around electric vehicles. Plus, buying a car 101. We'll be joined by an expert with 5 things that you need to know before making the purchase. That's coming up. General Motors reported its third quarter results this morning, boosting its full year outlook despite many near-term unknowns from the Trump administration. Pras Subramanian sat down with GM CEO Mary Barra this morning, and he joins me now on set. Pras, good to have you on this, and awesome conversation earlier. I mean, on his first day, Trump overturned a few Biden-era electric vehicle initiatives here. So how is GM thinking about those actions?
Yeah, Brett, so Trump reversed an emissions executive order which would have forced automakers to make more EVs. GM, for its part, is not modeling changes like tariffs or loss of EV tax credits in their guidance for now. Interestingly, GM sees the EV business actually providing a tailwind to profits if things stay the same. But no one's for sure. No one is actually for sure what's going to happen. So here's what GM CEO Mary Barra had to say about the loss of those EV tax credits.
We do think that there is a potential for EV demand to go down without the consumer tax credit or some of the other aspects of IRA. But remember, we started on our EV journey before we even knew IRA was going to be put in, was going to be legislated. So we're going to continue on our journey to continue to take costs down, provide great electric vehicles as well as great ICE vehicles, but great electric vehicles that customers want to have.
She said she might be basically targeting a bigger piece of a smaller pie if that tax credit goes away. But also, with regards to that tailwind that they're talking about, they had modeled 300,000 EV sales as the minimum amount that they would need to sort of hit that marker. If the tax credit goes away, the question is, do they hit that 300,000 EV wholesale, and then does that mean that $2 to $4 billion tailwind also goes away?
Do you think they feel like there's still pressure to deliver on some of the EV targets that they've set forth now that there has been this reprioritization, at least from the White House?
I think the investment community was sort of surprised that there wasn't any kind of takedown, or at least some caveats like, hey, this might happen, so we're actually going to give you this range.
Sure.
The range they gave was, this is what we expect as of right now. But I don't think anyone expects nothing to change from now until the end of the year. It is harder to get rid of that EV tax credit because it's in the law. You have to sort of repeal that in some way. But stuff like reversing EOs and getting rid of some of the charger money, that does affect sales. So I think that's the concern, that if you're going to prioritize gas-powered cars, is it going to come at the expense of EVs? And then for GM, do they get more profit than with the ICE or gas-powered business?
Sure.
And the EV stuff sort of just kind of stays where it is.
A great conversation with Mary, great breakdown. Everybody can catch your full story up on Yahoo Finance Plus. Appreciate it. According to Cox Automotive, January is historically one of the slowest months of the year for vehicle sales. But its new forecast shows sales volume this month is projected to grow 5% from the year prior. So if you're one of those people thinking of buying a car, well, we've got you covered. We're going to review 5 things you need to know about buying a car, including knowing your credit score, getting pre-approval for a loan, knowing the interest rates for a new versus a used car, and check how a purchase will impact your insurance. And if you're selling or trading your car, having a paper copy of the title. So here to dig into the details, we've got Brian Moody, Senior Staff Editor at Auto Trader, and Kelly Blue Book of Cox Automotive. Great to have you here with us. So let's start with your first one, knowing your credit score. Explain how that's extremely helpful for car buyers.
Well, it's just something you should know anyway as a consumer, anyone who consumes credit or makes large purchases. The deal is with new cars, especially when you see those special APRs advertised, low interest rate, that's not for everyone. That's for people with excellent credit. No problem if you don't have excellent credit, but you want to know that before you go into the process, not in the middle, because it will affect your payment if you're borrowing money to buy a car. Okay, next up here, getting pre-approval for a loan. What's that process like? That would be going to your bank or credit union and say, I want to apply for a loan. They'll have, for buying a car, they'll have requirements. Some banks will only give a loan to a franchise dealership, meaning like a Chevy, Honda, or a Ford. Others won't. By being pre-approved, you're not borrowing the money yet. You still will allow for the dealership to beat that rate, and oftentimes they can. But if they can't, then you have that in your back pocket. So let's talk about knowing your interest rate and what those payments are going to look like over time. Right. You should know approximately what interest rate you qualify for. That's tied to your credit score, and the bank can help you with that. Here's one of the things to keep in mind. Even if it's a lower price used car, like say a lightly used car, 1 to 2 years old, maybe 3 years old, used car loans are almost always higher interest than new car loans. So factor that into your buying decision. Now, obviously my insurance is going to be different if I'm purchasing a Ferrari versus purchasing a Toyota Camry. Yes. How will the purchase that you select ultimately impact your insurance? It will probably go up if you're getting a newer, nicer car. If you're getting an older car, it may go down. Sometimes electric cars can cost more because of the parts needed if you're in a collision. But here's what you can do. Call your insurance company and tell them, here's the car I'm thinking of buying. How will that impact my insurance? You don't want to buy the car and then be surprised a month later and say, oh, I didn't know. Ask them ahead of time. What is the pass-through when you sell or trade a car and the considerations that you could be taking into the transaction process? Well, decide whether or not you want to sell it yourself or if you want to trade it in. Oftentimes, trading it in will be a quicker process, but selling it yourself may get you a little bit more money. Either way, you're going to want to have the title to the car available and on hand to make that process go quickly and smoothly. For some people, they think it's worth it. Their time, their energy, fixing the car up a little bit, cleaning it, they think it's worth it to sell it themselves. For others, they just want to get rid of it and move on to the next car.
Thinking of the market dynamics right now, is this a good time to be considering the purchase of either a new or used vehicle or even an EV? What do the markets look like from your vantage point?
Yeah, a lot of the prices have been leveling off. We see some good prices on used cars, but remember, during the pandemic era, they stopped making new cars for a short time. That will result in, years down the road, and here we are, in fewer used cars. So those lease returns may not be as abundant as they once were. Looking for a lightly used car may be harder as we get into 2026.
Brian, thanks so much for the breakdown here and the tips for any of the car buyers and the prospective shoppers out there. Appreciate it.
Thank you.
Coming up, everyone, we get the latest read on home price growth from Kate Schiller, plus how homeowners are thinking about renovations in 2025. That's next on Wealth. Welcome back. We're taking a brief look at the markets here as we are 2 hours into the trading session here and looking for a bounce back. But is it a pure bounce back or a dead cat bounce off of the declines that we had seen yesterday here? Well, as of right now, the Dow Jones Industrial Average holding on to gains. It's up 0.1%. the Nasdaq Composite, where we saw the brunt of the declines yesterday. You're seeing that up for the tech-heavy average by about 1% right now. And then additionally, the S&P 500, that too is in positive territory. We're still net lower for the past 2 trading sessions here by 1%. But here today, fractional gains as we've been tracking it for the S&P 500 by about 0.4% there. Let's take a look at the Nasdaq 100 since much of that moved lower yesterday. And we'll put this on a 2-day view just so you can get a good aggregate of how much room there still is left to rebound here. NVIDIA, of course, with that massive $500+ billion decline day in market cap that we saw yesterday. You're seeing it higher here today by about 2%, but again, still in aggregate down by about 15% with yesterday's declines factored in. Hey, Apple saying, well, we're having a pretty good time over here in Cupertino. You're seeing things up right now for shares of AAPL over the past 2 days by about 7%. But let's also remember the broader trend here. I don't mean to go in and out of that chart, but over the past 10 days, keeping a look at Apple here, we're now back in positive territory with this move that we've seen. But year to date, it has been a move lower that we're continuing to track for shares of Apple. As of right now, year to date, still down by about 4%. Just lastly, we'll ride out with a look at some sectors here. We are largely in positive territory here. Technology still seems to be, and this is still on year to date. We'll put this on intraday. Right, so that changes things a little bit. Technology is up 1.5%. Utilities is down about 1.92%. Well, U.S. home buyers faced record prices in the past year. Existing home prices reached an all-time high in 2024, peaking at a median average of $407,000, just a little bit over that, according to the National Association of Realtors. The latest read from S&P Case-Shiller's Home Price Index showed November prices rose 3.8% from a year ago. That's the 18th consecutive all-time high. Here to help put in perspective what this means for the housing prices for the rest of this year, we've got our very own Danny Romero. Hey, Danny.
Brad, home prices hit a record high in November. And like you said, according to S&P Case-Shiller, the National Home Price Index gained 3.8% in November on an annual basis. Now, remember, this is a lagging indicator, and this data tracks a 3-month period through November when mortgage rates were moving up and down, but at the end of the day, they were headed towards that 7%, which was providing little relief for buyers during a seasonally slower selling season. Now, the index tracking home prices across 20 of the largest metropolitan areas gained 4.3% in November, and New York remained the top state with annual gains with a 7.3% increase. And this is because there is limited supply with such demand out there, Brad.
Danny, they tell me that your crystal ball is out of the shop and it's back fully operational. So where are home prices heading this year, and will home buyers get any relief from what we're expecting?
That's the big question for this year. Economists say that the slowdown in home buying activity could put pressure on home price growth to cool. But the scope of how much mortgage rates would fall really could limit the housing recovery at the end of the day, Brad.
Danny, thanks so much for taking the time here with us. Appreciate it. With home prices rising, mortgage rates elevated, and limited inventory, 67% of homeowners say they'd rather renovate their current home than move, with 93% of owners planning projects this year. That's according to data from home services company Angie. Joining me now on this, we've got Angie Hicks. She is the co-founder of Angie. Great to have you back on the program. What hurdles are homeowners facing when starting projects?
Absolutely. When homeowners are starting projects, in our recent State of Home Spending report, what we found was the 2 things that seem to be the biggest concerns is, one, is the difficulty sometimes finding someone to do the work. We've talked about over the years, we are in the middle of a trade labor shortage where there are more baby boomers retiring from the trades than there are Gen Zers going into the trades. So it makes it a little harder to find pros. And then additionally, surprises around budgets. So when projects come in over cost, homeowners are frustrated. It makes them stressed about the experience. So being able to understand how much something's going to cost is really important for them.
And so you mentioned the difficulty in finding skilled professional. What tips do you have for finding the right pro to work on and take on that project?
Well, when you're looking to hire a pro, you want to do your homework. Find out, check reviews of the company. You can, use Angie. You can check with neighbors to find out who they've used. And also, don't wait till the last minute. There are key types of service pros you're going to need to help care for your home over the years. That includes plumbers, HVAC companies, electricians. Find them early, develop a relationship. That way, when you need them, you're not in a hurry or an emergency situation. You know who you're going to go to.
Improvement spending, it dipped in 2024 with sticky inflation, rates still high. Will consumers continue to spend less on some of these projects?
Well, it was interesting when we kind of peeled back the onion on how much they were spending. We saw overall spending drop by about 12%. Home improvement in particular, so renovations, was only down a couple of percent. So it was a little flat, but obviously a number of factors. So first of all, inflation, interest rates impact that. But interestingly, 67% of people that would consider moving to find a house that meets their needs are thinking about renovating. So you have that going into play. And then overall, we're still spending a lot more on home improvement than we did, say, 5-6 years ago. People are still spending more time at home and making sure that their home fits their lifestyle.
When you do take on a home renovation project, does that change the considerations for your insurance and the type of insurability metrics that anyone who is servicing you or an insurer that is servicing you is going to, for themselves, also take into consideration and how that might impact your rate?
If you're doing a major project, it's always good to check with your insurance company because some projects will actually probably help your insurance rate. Putting on a new roof, if changing out the plumbing, upgrading your electrical, those types of projects might lower your insurance rates. But things like adding a pool or adding an addition to your home, increasing the square footage, those will likely increase your premiums.
All right, good to know. Angie, thanks so much for taking the time here with us.
Thank you.
Coming up, as the Fed holds its first meeting of 2025, we take a look at 5 keys here that we're going to be listening for and could reignite inflation. The FOMC's first meeting of 2025 is underway. As of this morning, the CME FedWatch tool is expecting the Fed to hold rates steady at this month's meeting as inflation cools and the labor market remains strong. But my next guest says there are several major issues that could reignite inflation. Neil Mukherjee, who is the TIAA Wealth Management Chief Investment Officer, joins me now. Neil, great to see you and thanks for joining the program again. You say that the biggest risk to inflation is inflation returning is economic growth, which under normal circumstances, that would be a great thing. So why is that the biggest risk?
Yeah, well, Brad, great to be with you, and good morning. Listen, the U.S. economy the pace of growth is quite remarkable, even now, 2.5% to 3%. You have a labor market which is still pretty strong, creating jobs at a consistent pace. The unemployment rate is low from a historical perspective. Whoever wants a job basically has a job at this point in time. And then we look at consumer spending. Consumers really haven't slowed down their pace of spending. And some of the spending is being supported by the higher income consumer, which is enjoying record levels of net worth. But also they're earning a lot of returns from their cash on the sidelines. So they're spending on the services side of the economy. And then investments into factories, into data centers, into research and development, et cetera, is quite healthy and good. So economic growth is quite firm. So from a Fed's perspective, if they stick to their 2% inflation mandate, they might be a little bit challenged. Now, if they're accepting of a higher level of inflation, then it's a different story. But economic growth, which is good for the stock market, for investors, still looks pretty robust to us.
Yeah, they've stood firm by that 2% target that they want to get us long run back towards here. You also lay out 4 other policies from President Trump that could be a risk: tariffs, immigration crackdown, higher deficits, and deregulation. So how are those potentially inflationary?
Yeah, Brad. So let's take them one at a time. So look at immigration, for example. There's no doubt that net immigration into this country over the last few years has increased the size of the labor force. It has enabled the economy to add jobs in a non-inflationary way. It has extended and provided longevity to this business cycle. So if you reverse some of that, that could mean a smaller size of the labor force, higher wage pressures on the margin. It could also lead to higher or lower demand on the margin as well. Now, Trump, the candidate, called for 15 million deportations. Let's see how much can really be done. That's the real story here. And we already see that the new administration is running into logistical issues and cost issues and even legal challenges. But the reversal of immigration certainly can be one of those inflationary forces. Let's talk about tariffs for a quick second. So tariffs, it's a little bit more complicated because the impact of tariffs on inflation and the economy in the medium term and long term is not very clear. But what I will say is, if you put it simply, higher tariffs means higher prices of products and services being imported into the country. And there's 2 things you can do with those higher costs. You can either pass it on to the consumer if the consumer is willing and able to accept it, or you can absorb it as an importing country into your own cost structure. So both those scenarios are not good for the economy, for inflation, for corporate profitability, and for stock prices. Now, the other wrinkle to the tariff question is the second-order impact of tariffs is even harder to gauge. So you could have a situation where the dollar could appreciate. That could negate the impact of the tariff against the currency of the country you're putting the tariff against. And the other countries can retaliate against the U.S. companies and U.S. economy, generally speaking. They could stop the export or slow down the export of critical raw materials, components, materials that our industry needs. So that makes it a little bit more complicated from a growth and inflation perspective. Now, you mentioned deficits, and the key to that is the extension of the tax cuts. So whether you extend the tax cuts or you have new tax cuts in the system, in the near term, that provides a boost to economic growth. So lower taxes means more spending by consumers, more money in their pocket. Lower corporate taxes could mean higher corporate cash flows, more investments, more hiring, a stronger labor market, more consumer spending. So all of that is good, more productivity for the economy. However, tax cuts are not free. So they can come with a higher deficit, and we are already running 6-ish% deficits, and that can lead to higher interest rates. So again, that can mitigate some of the positives that come with tax cuts. And that's why I think the main theme this year is all about how much can the new administration really get done, and how much will the bond market let the new administration get done this year.
And so for the Fed, they're unlikely to front run what the policies are, but to the extent that we hear in their tone how they're thinking about or how they're going to be talking about tariffs as they do get implemented, or even how immigration policy and mass deportations, how that might be felt in the employment situation as well. What do you expect to hear from them tomorrow, and how does it set the tone going forward, and how they're going to be tracking some of those policy announcements from the current administration?
Well, Brad, tomorrow's meeting is going to be like a walk in the park for Chair Powell compared to some of the recent other meetings that he's had to go through and pressers. But to your point, it's interesting. The assumption that most people made coming into the December meeting was that the Fed will not really react prematurely to any major policy shifts by the new administration. And it's going to wait for the policies to come into focus. It's going to observe the impact on the economy and then make changes to their forecast and then make changes to their monetary policy stance. But what we saw was some members of the FOMC actually started to incorporate the economic impact of the new administration's policies into their forecast, which was a little bit surprising, but which also tells me that those dots maybe move around a little bit more in the next couple of quarters. That can lead to some confusion with respect to the Fed's reaction function, and that will lead to more bond market volatility down the line. Yeah. Now, coming back to the Fed one more time and their focus for the next few meetings, listen, the Fed is in a difficult spot. They have cut interest rates by 100 basis points. The data has been quite firm, both on the growth side and on balance on the inflation side as well. So they did the right thing when they came into the December meeting. They pulled back their expectation for the number of rate cuts they're looking to do this year. And they pivoted more towards the risk of inflation breaking out away from the risk of a weaker labor market. So that's good. Now, the key here is the neutral rate.
Yeah.
Where is the neutral rate? So there's a lot of disagreement on that among Fed officials, among market economists. The Fed seems to think that the neutral rate is more than 100 basis points below the Fed funds rate. Many market economists believe it's 25 basis points to 50 basis points below where they are now. So if inflation data cooperates with the Fed, they're likely to go ahead and do the 2 rate cuts that the market is pricing in now.
Right.
If you watch the unemployment rate, if that moves up, you will get more rate cuts this year.
Neil, we got to leave the conversation there. Always a pleasure to grab some of your insights. Thanks for joining us.
Thanks, Brad.
Certainly. Coming up, is inflation eating into your cash? It may be because your money is in the wrong accounts. Our next guest lays out how you can make your money work for you. That's next on Wealth. A programming note. In this week's episode of Decoding Retirement, host Bob Powell speaks with David Blanchette, who is the head of retirement research at PGIM DC Solutions, about how retirees should plan for longevity risk.
How does someone go about figuring out whether I plan for a year of retirement or 35 years of retirement?
Yeah, so I know we're supposed to avoid like fancy terms, but longevity risk is this kind of widely discussed risk where the longer that you live in retirement, like the more expensive it becomes. And no one wants to retire and like die the next day. Like we want to have a long retirement, but the problem is that uncertainty of how long you're going to live, it just radically complicates what we're supposed to do and how much you're supposed to save. And so I think that one thing that hasn't been great for America is this movement towards defined contribution plans. And let me caveat that just because it's really hard when you get to retirement to figure out how you're going to create a plan based upon all these idiosyncratic risks. So I think that longevity is a huge issue. I think it's really important to personalize your number.
You can catch episodes of Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Nearly 2 in 3 Americans think the money in their bank accounts is not keeping up with inflation. But it's not all the economy's fault, according to our next guest. And there's plenty that you can do to get a better return on your cash. Joining me now, we've got John Kiernan, who is the managing editor at Wallet Hub. John, good to have you here with us. So explain more on what you mean there.
Sure. We did a nationwide survey to see how people are feeling about how their money is keeping up in the current environment and how the deposit account market is helping them. We found a lot of dissatisfaction, as you said. Around 2 in 3 Americans think the money in their accounts is not keeping up with inflation. It's easy to feel that way when you see prices going up at the store and kind of your bank account balance not really budging or going down. Also, a lot of people, 2 in 5 Americans think their bank is taking advantage of them. That kind of goes into the same sentiment as we just discussed. People are thinking their bank is making money off them in loans, and they're not getting a fair return, and they're getting nickel and dimed in terms of fees. And while there is a lot of that going on, part of the problem is that people are kind of thinking inside the box when it comes to where they're going to put their cash. For example, 39% of the people we asked said that unfamiliarity is the main factor preventing them from trying a small bank or credit union. So a lot of people have just kind of been always putting their money in one of the big banks and not really worrying about the small side of the market. It turns out that is a dangerous strategy because you're losing a lot of money on the table. Credit unions offer 39 times higher interest rates on average on checking accounts than regional banks, and they offer about 10 times higher rates on their checking accounts than national banks. Credit unions also are 78% less expensive than national banks for checking accounts on average, and they offer about 1.5 times more features on average. So you're getting a lower cost, more features, and a higher return, which are all things that can really kind of be in your corner fighting against inflation and high prices.
Right. So you recommend, John, only using, and maybe not only using, but you recommend these online-only savings accounts in particular as having some of the best savings rates. So why are online-only firms providing better?
So yeah, credit unions are best in terms of the branch-based accounts and checking accounts. When it comes to savings accounts, they're the best rates you're going to get on the entire market, including banks and credit unions, are from online-only personal savings accounts. So they have less overhead. Obviously, they don't have branches and as many people to kind of afford. So they're able to give more to consumers. So they offer about 5 times higher returns than branch-based savings accounts on average, and you get about 3.2 times higher rates than traditional checking accounts. So the ideal strategy in the current environment, based on the market averages we're seeing, are put your savings in an online-only account to get the highest possible return, and then explore at least a checking account from a credit union to get more for your money than a lot of the big banks are willing to give you.
We only got about 30 seconds. Which institution has the best savings rate?
So right now, the one we recommend is the Pacific International Bank Savings Account. You're getting 4.75% APY on that. In terms of a checking account, we recommend the Primus Premium Checking, and you're getting 4.2% APY on that. So both above 4%, whereas a lot of the big banks are going to give you just a tiny fraction of that.
John, thanks so much for taking the time here today and breaking down some of these tips for us. Really appreciate it.
Thanks for having me.
Certainly. Let's do a final check of the markets here as we're taking a look at the major averages, all of them in positive territory right now, reversing from some of the declines that we had seen in the tech-fueled sell-off on Monday. The Dow right now is up by about 0.1%, sitting right in between there. S&P 500 up 0.5%, and the Nasdaq Composite, that's up about 1.3%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. They'll count you down to and through the market close.
It's time for Yahoo Finance's Market Minute. We're seeing green across the screen with the Nasdaq leading stocks higher after Monday's massive tech rout. Chip giant Nvidia is leading those gains. Shares up nearly, actually it's just over 4% right now after the company lost about $600 billion in market cap on Monday. Investors are now weighing whether or not the sell-off, which was spurred by China's DeepSeek AI platform, was overblown. Plus, Royal Caribbean shares rising after the company delivered an earnings beat and strong guidance. The cruise operator saying it's encouraged by demand as well as the current pricing environment. And we're seeing a mixed picture for defense stocks. Shares of Lockheed Martin lower after missing on net sales. Its missiles and fire control unit posted a loss of $804 million. Meanwhile, RTX is moving higher following a strong profit beat. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.